Another way to think about it is, if I took Apple and all the people that worked at Apple, right? It's a $2 trillion company, and put them on one side of a football field, and then I put all the intelligent people working around the crypto, the Bitcoin ecosystem, from the entrepreneurs to the technologists, and we had a fight, we'd have applesauce, right? The amount of human capital in our space is increasing by the week. The level of talent that we can hire at Galaxy, that we're seeing move into our competitors, is increasing in a quantum. And so I'm like, we're 30 basis points of global net worth. I wouldn't be in this business. I wouldn't hire 400 people if I didn't think in 2 to 3 years we were going to be 5 to 10 times that. And so I actually don't even see my competitors as competitors. I see them as collaborators, right? We're all in this revolution trying to pull people into the tent. We need competitors. We need more people in this space. That's how it grows. And so I couldn't be more optimistic, quite frankly. You know, people get upset that the price went from, you know, 60,000 to 40,000. At one point, you had to kind of brush that off and not miss the forest through the trees. The real story is this incredible influx of talent into our space, and an open-mindedness of investors that used to have a closed mind.
And I think COVID probably was one of the things that opened up their minds to this store of value narrative. You mentioned earlier you don't see Bitcoin becoming a global reserve currency, which is something I'm sure many people in the audience would like to see.
So I think it can become a global reserve asset. I think within the next 24 months, a central bank or a sovereign wealth fund will buy Bitcoin as an asset. But I don't see people trading it as a currency. The central banks just don't want that. And governments have a lot of power. Listen, if the United States really screws it up, if Janet Yellen and Chairman Powell really cock it up, and our currency starts looking like Venezuelans, yeah, all bets are off, of course. But we're a long, long way from that, right? We have decent stewardship. People aren't buying Bitcoin not because they think we're going to go into a hyper devaluation. They're buying it because the probability that that could happen went from really little to a little bit more than little. And so it's a hedge versus this debasement of currencies. Most of that debasement happens slow, right? You don't notice it, right? The British pound sterling, you know how many pounds it now takes to buy a pound of sterling? That's been about a 97% or 98% devaluation over the last 75 years. Citizens don't notice that. They're okay with that. And so that's one reason you hold Bitcoin long term. But it's if we have a breakdown of confidence. They call it in economics the Minsky moment, right? When confidence breaks, the yield curve steepens, the dollar plunges. In that case, all bets would be off. I think we're a long way from that.
Mm-hmm. And it's a self-reinforcing process. The more people who believe Bitcoin's a store of value, the more that narrative is going to cement itself.
It is about getting people into the tent. My niece once said, "Are you the CEO of Bitcoin?" And I laughed because I kind of wanted to be. And I was like, no. There's no CEO of Bitcoin. One of the wonderful things about this ecosystem is, you know, one day it's Michael Saylor, and the next day it's Dan Moorhead, and the next day it's, you know, some guy in a village in Indonesia convincing his people that Bitcoin is this wonderful store of value. Bitcoin is owned by over 140, 150 million people. The story is told in every village in every country in the world. It's the most distributed asset in history. Think about it. We collectively have built one of the great brands of the last 100 years in 12 years. There's never been a brand built this fast with this much distribution. Mm-hmm. And so the Bitcoin community should take a bow. I look at the OGs and, you know, even Roger Ver, who people like to throw things at. I was like, dude, it wouldn't be here without those guys that were pioneers. And so I always tip my hats to the early guys.
Mike, when you harken back on those early Hasleon days of the Bitcoin world, did you expect it to get this big? Clearly you did, that's why you got in, but like, it must be sort of jarring to look back on hindsight.
You know, we've seen this a couple of times with technology in the last, 20, 30 years. I was at Netscape early, and I remember driving down the highway and seeing the first URL on a billboard. And I was with some of the really early guys at Netscape, Rob McCool and Mark Andreessen, and for them, it was completely phenomenal that this thing that they had worked on really as a college project, this World Wide Web thing, was now on billboards. Did they expect it? Yeah, they did. Were they surprised to see it? Yeah, they were. So I think we're in the same phase here, which is, people are getting into this. They're seeing that, we have the opportunity to change the way the financial system works. Very few people are perfectly happy with the financial system today. We are very much a global people as opposed to the local peoples that we've had, and there's an opportunity to change. So it's gratifying to see the ecosystem where it is today. Because a few years ago, everybody said, Bitcoin, huh? Okay, maybe, I'm not sure. And then increasingly, of course, we're seeing changed minds everywhere, and so it's very validating.
But in some ways, it seems like Bitcoin's just becoming intertwined with the financial system versus completely usurping it.
Of course it is. I mean, I don't think you'd want to usurp, right? But being embraced as a legitimate part of it is what it takes to get started. And the digital asset world, Bitcoin has the ability to do much more, but it's got to take hold, as Mike said, across people in every community, every industry, et cetera, first. The high volatility will go down as it gets bigger. It'll get safer as it gets bigger. We'll have more participants as it gets bigger. You don't want to have single counterparties that you're dealing with. So, of course, it has to adopt that way. But once it gets to a larger and larger size, more interesting things can happen. That's actually where the most change the financial system will occur.
One thing I find interesting, and specific to Bitcoin versus all the other cryptos, is how do you value things? How do you dream the dream and figure out where things can go? In Bitcoin, we have a pretty good yardstick, right? We know what the market cap of gold is. And so I remember at the beginning of the year, I thought 65,000 was my target, pretty darn close. And that was because it was going to be roughly 10% of gold, 12% of gold. And I thought that would be the next leg of the journey. I was talking to Bill Miller, who might be the single best investor, and he's a huge Bitcoin fan that I know. And he's the largest owner of Amazon, whose last name isn't Bezos, personally. I didn't know that. I was like, oh, Bill's a lot richer than I thought he was. And I talked to him about how he held it so long, and it was the same thing. He said, once Bitcoin gets to 10% of gold, you're going to be telling people it's going to go to 20. And then at 20, you're going to see 40. And at 40, you're like, of course it's going to be gold. And that's the process we're going through, right? If you think about where gold is, that puts Bitcoin at about 500,000 in 3 or 4 years. And we're tracking that. In every analog to digital transformation, the digital always way surpasses the analog, right? At that point, we probably are thinking of other use cases of Bitcoin, But at this point, for me, I look at it as a percent of gold, and it's not going to all happen overnight, right? These things take time. People that buy it at 10,000, at 50,000, they 5x their money. There is an impetus to pull the trigger, to ring the cash register. It is the human psyche that everyone, sitting with the position, hodling as it is said. You have to handcuff yourself to the chair. It is not normal for us to just hodl, right? The normal instinct is, I got to book some profits. And part of it is you make a whole lot of money. You want to buy a house. You want to buy your girlfriend a diamond ring. You want to send your kid to college. And so we have these natural shifts up where then people are going to sell and take profit. We rebuild. We need a new narrative. We head up again. And I think that's the process. Listen, we have some headwinds this year, right? The biggest headwind I see, forgetting the environmental concerns that I'm sure will get addressed, I saw Don Wilson back there, he's pretty damn good at it, is because everyone got jabbed, the economy is roaring back. And there's a decent chance the Fed is going to flinch, that Powell is going to taper early. And when rates start going up, the big narrative for why we were all long Bitcoin this year, right? Printing press forever, is at least going to put on pause. And so, again, I don't think anyone should expect Bitcoin's going to go straight to the moon, even though I have a Bitcoin go to the moon tattoo on my arm. And I have a song, but I'm not going to sing it, I promise.
I thought you were going to sing it.
Maybe on the last day. I need a few more cocktails. This is too early for singing. But I do think, right, be prepared, right? Don't think that this is the one-way rocket ship. We're going to go in waves, but as long as we continue to see adoption, the future looks really sunny.
So Novo touched on a big headwind, which is this macro picture. We only have a few more seconds left. Mike, give us a tailwind to close things out. What's a big tailwind that we haven't talked about that will help Bitcoin adoption, aka please Moon? What are you seeing?
Well, look, I mean, I actually think that in spite of the headwinds, I think it's pretty much all tailwinds. It just depends on your time horizon. The short-term changes as we go through various struggles, of course we want to have clean energy. Of course we want Bitcoin to be a strong participant in pushing that forward. And guess what? It's probably the only product out there that actually can help us evolve to better, cleaner energy. So we're going to take some hits sometimes where people are kind of getting concerned about this issue or that. A few years ago, it was, are the institutions going to come at all? Guess what? They're coming. Then it was like the corporates. Are they going to come? Guess what? They're coming. So you've always got new obstacles to jump, but we are jumping them.
Let's do it. Let's jump to the moon.
Let's jump the moon. All right.
Thanks, everyone. Thank you.
Thank you, guys.
Thank you.
Hey! Hey everybody, good to see you again. Transitioning here over at Bitcoin 2021 Whale Day. Love to see all the new people here and appreciate you guys coming out and being up early. I'm a morning person, so I can relate to all of you, and thanks for coming out. So, did a show of hands earlier. Obviously, a lot of you, this is your first Bitcoin conference. Obviously, I'm here representing Bitcoin Magazine. I want to do another show of hands a little bit. How many people here read Bitcoin Magazine? Oh, too few hands here. You guys got to go to bitcoinmagazine.com, check out all the great content there. And I want to say a little bit about the publication and its mission. Obviously, it's Bitcoin only, right? You guys who might be new to the Bitcoin and cryptocurrency sector, there's a lot of other options for news out there. And I would say, Bitcoin Magazine's mission is to promote Bitcoin, right? There's a lot of other cryptocurrencies out there. You're probably not going to hear too much about them today. As a veteran of the space, I've been here since 2013, and I would say, these are not stocks and bonds. This is new. This is new stuff that we're doing here, and in a lot of ways, Bitcoin is an invention, right? It did something, it achieved something scientifically that was simply not possible before, right? So I think it's helpful to think that we're here to talk about investment, but we're still talking about science. Bitcoin is the first decentralized money system. And that's really, I think, the mission and the spirit of Bitcoin Magazine. And if you guys want to check that out, again, bitcoinmagazine.com is a great place to check it out. A lot of great resources, a lot of great guides. If you're between sessions, check it out and follow it on Twitter as well. So transitioning, going to talk about the next panel here, Turbulent Times, how money, finance, and investment is being transformed by Bitcoin. That's going to be the next panel. Ready to introduce the participants here. We're going to come out on stage. You guys ready? We're getting the thumbs up. All right, guys, next session coming on here, we're going to introduce Eric Bethel, private equity veteran and distinguished fellow at the Chamber of Digital Commerce. Welcome, Eric. Next, we've got Mr. Don Wilson, founder and CEO at DRW. Joel Kruger, strategy at the LMAX Exchange. And last but not least, your moderator, who I'll be turning it over to, Perry-Ann Boring, president of the Chamber of Digital Commerce. Perry-Ann.
Thanks so much, Pete. It's great to be here in Miami. In person, in the flesh, humans, face to face. So glad this day has finally come. We have an amazing group of experts here. We wanted to talk about why Bitcoin is important. Where does it fit into the conversation today? And from my perspective, in order to really understand the potential promise of this technology, you have to understand where it fits into the macroeconomic landscape. So we're going to get real nerdy, talk about monetary history, talk about how the economy, the international economy has evolved over the past several years, and then talk about where this fits into that. So where we are today, I think we're in a very pivotal moment in economic history. I think the history books are going to be written by us, and I think what the international financial and monetary landscape looks like today is being changed dramatically right now, and blockchain technology and Bitcoin and cryptocurrencies are going to play a key role in what the future of all this looks like. So just to kind of walk us through how the economy has evolved over the past several years, going back for centuries, hundreds of years back, civilizations have flocked to things of scarcity as money, predominantly gold and silver, but even things like wampum and shells and salt and other commodities. In 1941, the post-World War II, the world came together and created the Bretton Woods Agreement. And in that agreement, it said that the US dollar would be the world reserve currency, gold would be pegged at the price of $35 an ounce, and all other nations would peg their currencies to the US dollar. That lasted for about 1 minute. It completely broke down. 1971, you guys know this history. President Nixon severed the gold standard. By the 1980, all industrialized nations were using floating exchange rates, and that brings about the birth of, I think, what we call this fiat experiment. So turning it over, Eric, I'll start with you. Eric previously served at the World Bank. You guys looked at macroeconomic indicators. Where are we today? Has this been successful? Do you think the economy is healthy? How do we know that or not?
Wow, that's a lot to take on in a short soundbite. One of the things that you probably should have mentioned before Bretton Woods was we had close to 100 years of a gold standard. The UK, I think in the 1820s, was the first country to peg its currency to gold. The US, France, and others did it as well. And so the British did it at whatever, 4 pounds per ounce of gold, the US at $20 per ounce of gold, and you could sort of peg exchange rates to each other relatively easily. What broke down Bretton Woods was the same thing that broke down the original gold standard, which was governments do what they want to do, right? And that is print money. And so the presumption was, back when we had a proper gold standard for 100 years, that you had to have a certain amount of gold in reserves to back up your currency. But World War I upended all of that, and the European powers printed more money than they had. And to answer circuitously your question, where are we today? We're kind of in a similar position. I mean, looking at the United States, I don't know how you can rationalize $27 trillion in debt, a $6 trillion budget, and the list goes on. And it's not just the US, it's pretty much, it's everywhere.
So unsustainable levels of debt. The global debt to GDP ratio is over 300%, meaning we're spending more than 300% of what we're producing. How does, what's going to happen in the long run there? We have a huge gap in financial inclusion. Maybe Don, I'll just ask you, where does Bitcoin fit into this equation? Like, why is it important? Is it going to solve any of these issues? Is it going to fix any of this?
Well, so stepping back a little bit, just to touch on some of the earlier parts that you were talking about, Bretton Woods and why was it created? I think that there was broad consensus at the time that one of the things that led to World War II was actually the hyperinflation in Germany. And so obviously, anything that the world could do to prevent a repeat of that was worth trying. And what Bretton Woods did was it attempted to really handcuff central banks and prevent them from printing too much money. Again, kind of tied everything to gold, which is a good way of solving that problem, but really removes a lot of flexibility for central banks. And right now, what we're seeing is, of course, that governments want more flexibility than that. Biden's proposal is to spend $6 trillion on infrastructure spending. And that's after trillions of dollars have been spent and handed out during the coronavirus pandemic. So does that mean that we're going to go into a period of dramatically higher inflation? It's certainly possible. And we went from, I would say, a very low probability of that happening to a much higher probability of that happening. And so any time that there's a higher probability of dramatic, purchasing power reduction of one's currency, people start thinking about, okay, well, what should I use as a store of value? And of course, historically, gold is what has been used. And I guess the question right now is Bitcoin a better version of gold? That's probably what we should be asking.
Yeah, absolutely. There's been many statements from a number of different officials at the Federal Reserve who have made that connection that Bitcoin is starting to take the role of gold, or looking more like a gold 2.0. In fact, Jerome Powell, earlier this year, he said that Bitcoin is more of a substitute for gold than the dollar. Since the Fed owns gold as reserves, would it make sense? I mean, what do you guys think that the Fed will start owning Bitcoin? And other central banks around the world.
So here, one of the things that I was looking at, as I was preparing for this discussion is, how much gold does the Fed own? And it turns out that the Fed owns at current values about $500 billion of gold. That's at $1,900 an ounce. And by the way, the Fed owns more gold than any other central bank. The next largest holder of gold is the German central bank, which owns about, 40% as much. And so, why do they own gold? Well, they own gold as a hedge against hyperinflation, as a tool that they can use if there were to be a dramatic reduction in purchasing power of their currency. Now, is $500 billion of gold really going to move the needle? When you're talking about, when the Fed owns trillions of dollars of treasuries, and if we do a $6 trillion infrastructure spending bill, then obviously the Fed's going to wind up purchasing a bunch of those treasuries. I mean, that's what happened last time. It's probably going to happen again. So I'm not sure that the $500 billion of gold is really going to do that much good, but it's going to do something. And so the question is, should you only own gold? As if you're running the central bank and you need to have some kind of hedge against very high inflation, should it only be gold? And one fact is that the amount of gold in the universe is very, very large. The amount of gold on Earth is a tiny fraction of the amount of gold in the universe. And so gold is only valuable because of its scarcity. Apparently there's a single asteroid, Site 16, that has more than 100 times as much gold as we have on Earth. So if you think that there's even a 10% probability that asteroid mining is viable in the next 20 years, then I would think if you're running a central bank that you should start thinking about other ways of owning scarce assets.
You make a great point. I don't know if any of you guys watch Barstool, but the Winklevoss twins tried to explain this exact same point to David Portnoy, and his mind just exploded. He's like, what? Asteroids raining gold? That makes Bitcoin relevant. That was very well said. In honor of it being Whale Day, wanted to also touch on institutional investors and how institutional investors are looking at Bitcoin. Because it is a non-correlated asset, there are advisors that are adding it to portfolios for diversification purposes. Joel, you guys deal with a lot of institutional investors. Dawn, you do as well. Some RIAs have come around to this, other fiduciaries less so. Why is that? Do you feel like the case has been made? If not, what is missing?
So I just want to go back to the gold.
Asteroids mining gold on Earth.
Well, not about asteroids, but as far as central banks considering Bitcoin, I think it's highly compelling. And if we look at the past several years and we look at central banks and alternative strategies, you've seen central banks and their balance sheets go towards equities, be more aggressive with the equity markets. And so when you're looking at an asset like Bitcoin, and you talk about intrinsic value and gold, and you compare gold to Bitcoin, and you look at the scarcity of Bitcoin relative to gold, and then you talk about intrinsic value, well, you could easily make the point that Bitcoin has a deeper intrinsic value than gold, which I don't know that it really has any intrinsic value. And it becomes more compelling when you look at a currency overlaid on a technology that does offer what I would argue to be some intrinsic value. So I think that that's compelling. As far as institutional adoption goes, I think that we're moving in the right direction. LMEX digital volumes have been just skyrocketing over the past several months. We're at 10 times what we were 12 months ago. We did 75 billion in volume, total notional volume, just this past month. And I think that it just comes down to, we need to understand that, when it comes to institutional investors, yes, decentralization is great, but at the same time, investors also want to have the comforts of a trusted institution right now, and we have liquidity and technology that are there, and I think that's what investors are looking for, to have that comfort that they're going to be allocating large sums of money.
Yeah, absolutely. The infrastructure has to be there. Very regulated, mature investors need strong, safe, regulatory clarity, and all the things that come with that. Okay, so we've talked about Bitcoin being a store of value. The Fed's talked about that. Central banks have talked about that. Institutional investors are recognizing that. Another piece of the macroeconomic dynamic and landscape that really plays into the adoption of this technology is what central banks are doing beyond maybe putting Bitcoin on their balance sheet, which would be the idea of central bank digital currencies and stablecoins and DeFi. So 3 kind of very interesting pieces that are all being developed by this community as well as the central banks. So if you have central banks issuing their own digital currencies, you have stable coins, which are really taking off in a very prolific and meaningful way, and then decentralized finance, which is really changing the dynamics of how people and individuals can engage in financial transactions globally with greater speed and efficiency and privacy considerations and things like that. How are these two worlds going to collide? Where do you guys see this going? If we meet here in 10 or even 20 years, how is this going to play out? What are central banks' roles going to be? Are we all just going to be operating in the metaverse on smart contracts? Where's it going?
Well, again, there's a lot there. Let me just tackle one at a time. The thing that a lot of people aren't talking about today, and it's probably one of the more important things, is that the Bank of International Settlements reckons that, say, 60 to 70% of all central banks are working on a digital version of their own fiat currency. Now, many of us in this room are, let's just say, skeptical of fiat currency for many of the reasons we alluded to. But central banks, what they're doing is that they're turning their bills and their coins into QR codes. That's happening as we speak. Now, imagine a world, though, and by the way, this is the Chinese are doing something with it that's taking it to yet another level. Many of you may or may not be familiar with the Chinese social credit score, but it's kind of like a regular credit score at a bank, but it also includes what did you buy at the store? Did you buy too much alcohol? Did you jaywalk? Did you, have you read?
Did you buy a religious book?
Did you buy a religious book? Did you attend a pro-democracy protest? All of these things factor into your social credit score, and to say it's an understatement to say it's Orwellian, right? Now, imagine now the People's Bank of China being able to track everyone's transactions 100% of the time, 24/7. And it could be very frightening. People could get canceled for doing anything that the government doesn't want. Now imagine a world where that technology is going to be exported throughout the world. So maybe this is a dystopian view of where things are headed. And here's where worlds potentially could collide. What if China, with their central bank digital currency, also known as the DCEP, what if they said Chinese digital renminbi DCEP transactions to Bitcoin won't be allowed, and they can stop it, right? And so, all of these things have to be interconnected, and governments authoritarian governments and dictatorial governments are going to want to control their people through their currency. And maybe this is where Bitcoin can provide, I don't know, freedom and liberty in this context.
Yeah, you talked about some of the concerns I think many of us share with China's dominance and investment in this space. I've looked pretty closely at what they're building with DCEP, and the ability to surveil is like nothing I think the world has ever seen before. So we're also having a lot of conversations at the Chamber about, well, what should the US be doing? What should the Fed be doing? What should the Fed be thinking about? There's a lot of different opinions on this. Don or Joel, do you want to kind of share what your perspective is on that?
Well, so I think that if the United States wants to ensure that the dollar is maintained as the reserve currency, it's essential that we move forward with some kind of a central bank digital currency. And of course, you can replicate what the Chinese are doing and use it to surveil your population and whatever. I'm certainly hope that we don't go in that direction. You can also, in a very thoughtful way, design it in such a way that privacy of your citizens is protected, but at the same time, that there's a mechanism where, the FBI or CIA can investigate terrorist activity under, the right structure. And so that's what we should be doing here, is making sure that we design a digital dollar that's issued by the Fed in a very, very thoughtful way.
But we should have standards, right? I mean, we should say, as Americans, we should promote certain, let's call it principles, like a Magna Carta of sorts, where we say no government should be able to use currency to surveil citizens without a warrant, right? The Fourth Amendment prohibits unlawful search and seizure. No government should use a currency to force citizens to buy certain things or not buy certain things. So there need to be a series of principles that should be written. Maybe the Chamber of Digital Commerce can do it. No.
Playing devil's advocate on central banks and the Fed building and issuing their own digital dollar, there are some that would say, do we really want to expand the Fed's role in the financial system? Don't they already play a large enough role? Why would we hand them over this infrastructure and make it public when we have things like stable coins that have multi-billions of dollars of volume already on them? Since they're stable coins, they've been built by the private sector.
Well,
thoughts on that?
I mean, as far as the stablecoin issue goes, I would be shocked if the Fed would be willing to give up that power. They want to be able to control the money supply, so it would not be in the best interests of the Fed to have a stablecoin. As far as the issue of central bank digital currencies go relative to the topic of Bitcoin, I think this is getting a lot more attention than it probably needs to get. Sure, a central bank digital currency the idea of getting payments out faster, stimulus checks out faster, cheaper bank accounts. That's all great, but we are looking at a centralized currency, single point of failure, centralized currency that serves a completely different purpose. Now, again, in an economy like the United States, if you have options and checks and balances, sure, you can have such a currency that might be able to serve certain purposes, but you need to have other options. The prospect of a digital currency in China, I think, a lot scarier.
Yeah, I do think, right now, when the Treasury prints dollars and distributes them, at least in a positive interest rate environment, they're basically getting free float. And if you just let the private sector use, private tokens, then basically you're letting the private sector take over that role to take in the cash, deposit it in interest-bearing accounts, and issue these non-interest-bearing tokens. So I think that that the United States Treasury / Fed will want to maintain that ability to earn that interest-free, to make those interest-free loans.
Right, and then let's take this back to how we started this discussion. We got off the gold standard in World War I because the European powers printed more money than they had gold in reserves. If you take, you guys, some of you may hate me for saying this, but Tether is not backed 1-to-1. I think that's kind of obvious, and they've even made those statements. So the presumption is for every Tether that's issued, there's got to be $1 in the bank, and it's it's a question mark. And so is the Fed going to outsource monetary theory, its monetary powers to Tether? I don't see it.
Yeah, certainly a lot to unpack there. I think the next several years are going to play out in an interesting way. In my opinion, I think there's a lot of different stakeholders whose roles and power and positions are going to change, and we're all witnessing that in real time here. Bringing it back to the institutional advisor, why we're here for Whale Day. Joel, what do you see? You kind of talked about some of the challenges of infrastructure, regulatory clarity. There's kind of two different philosophies right now, as I've talked to a number of investors, corporate and institutional, about their theories on what's going to happen right now in this current market. One is there's been three happenings: bull market correction, bull market correction, bull market correction. Are we going to see that again? Or are institutions going to front run and we won't see that correction? So can you give us any insights to your pipeline, your thoughts? What does institutional demand look like today?
Well, again, in institutional demand, I think 2021 has been an incredible year for Bitcoin and cryptocurrencies. Much like back in 2017, 2018, we had the initial kind of wave of adoption across the retail sector. I think 2021 has been an amazing year as far as institutional adoption, and we're seeing that, and we're seeing, structurally the solutions are there now for that to come on. As far as the trajectory of the price of Bitcoin and how that's going to change, I do think that we continue to see these ebbs and flows in the market that all markets will show. I don't think that will change. I think we'll continue to see corrections. I think the broad trajectory, if you believe in the economics of Bitcoin, is going to continue to be higher. We will see dips, but this year, we're starting to see that institutional demand come in on the spot side especially, which is very important because it establishes that stability within the market. And so you're going to see corrections, but higher lows throughout, and very optimistic about the outlook.
Don, as a prolific investor and trader in this space and in this room, I'm going to give you the last word. How do you value Bitcoin when you're looking at the day-to-day, you're looking at the markets? There's a lot of factors that play into how investors kind of try to determine where this is going. Where is it going? What type of predictions are you willing to share with us?
Yeah, so I don't make price predictions, Perry-Ann. I will say, I sit in an interesting place. Cumberland is an important OTC liquidity provider in the space, and so we have a lot of context of kind of what's going on there. And we're just seeing a lot of important names coming in and a lot of major flows coming in. And so I think pretty broad recognition that this is likely to be a gold 2.0. And so then you can start thinking about, well, if it's gold 2.0, then how valuable is it relative to gold as a total market cap, and maybe should it trade even be a premium? And that starts to give you a sense of kind of that. That's how I think about, in the long run, how to value it.
Absolutely. Eric, Don, Joel, thank you so much for your insights. Please help me thank all of our speakers today.
Thank you.
Hello. Hey, everybody. All right. Man, we've seen a lot of stuff so far. Just took a deep dive into monetary history. Appreciate you guys staying attentive. Obviously, still early. A lot of day left. We're going to turn it over to our next panel pretty quick here. They're going to talk to you about how to invest in Bitcoin. So obviously, if you guys have not done that, I assume if you're here, you might have. Quick show of hands, is there anyone here who doesn't own Bitcoin? Anybody admit that? Oh, everybody's looking around. I shouldn't have asked that question. Well, if you don't, this panel may help you get over that hump. I, for many years, did not invest in Bitcoin, and I regret it, and I'm sure maybe that's a story that many of you can relate to. Anyway, I'm going to turn it over to the panel here, introducing everybody. First up, we've got Mr. Greg Carson, partner at XBTO. Next up, we've got David Roba, principal at Wave Financial.
Yours is tough.
Next, we've got Paul Veredicate, partner at Pantera Capital. And last but not least, Mark Musko, founder at Morgan Creek. How to invest in Bitcoin. You guys take it away.
All right. So, just to be the skunk at the garden party, we're not going to talk at all about how to invest in Bitcoin. So we're going to go totally off script, and we're going to talk about investing in the ecosystem around Bitcoin. So let's first define that. So Paul, how do you think of the word ecosystem when we're talking about Bitcoin?
Yeah, I think for us, just quick background. Pantera Capital, we manage about $5 billion of assets in the ecosystem. And the ecosystem for us includes a Bitcoin fund that we help people buy Bitcoin. Think of it as sort of like a white glove service for high net worth individuals and institutions get exposure to just Bitcoin. But surrounding our Bitcoin fund, we also invest into cryptocurrencies, and we also invest into companies. And so the types of companies that we invest into that we think are related to Bitcoin revolve around, brokerages and exchanges, things that we think make it a lot easier for retail and institutions to get exposure to Bitcoin and other related cryptocurrencies. And then other sort of companies that we think are helpful for Bitcoin would be including things around yield and lending. Right now, especially with what's going on with governments and money printing, a lot of people are coming to Bitcoin specifically for that sort of diversification of wealth, store of assets, etc. And then, beyond being able to generate more yield during this time, one of the biggest use cases of Bitcoin is really, and cryptocurrency is really just cross-border payments. So we're seeing a lot of companies out there that, for right now, you don't need to know anything about Bitcoin. All you need to know is that cryptocurrencies allows you to send value in a peer-to-peer way from one party to another party without intermediaries such as banks. And so you can send value faster, cheaper, and more transparently. And so those types of companies are really just ones that we think are exciting because they really just take away the complexity of cryptocurrencies, but allow you to actually move money in a more efficient way. So those are some of the types of examples that we are investing into when we think of the ecosystem, things that will just use Bitcoin and get people access to Bitcoin.
Yep. Greg, how do you view that word ecosystem, and how would you think about investing in it?
Yeah, I think we're the same at XPDO Ventures and the Humla Fund. We're focused a little bit more broadly on fintech AI stuff, but with a very heavy focus on how the ecosystem to support Bitcoin short-term and long-term work. And so that meant that like our investments are in things like we were one of the early investors in like Deribit, which is options and derivatives. We have an options derivatives background at the firm. So we're looking at a lot of the principal systems that basically support the liquidity, the transformation of Bitcoin. So if you look at Bitcoin itself, you look at markets around Bitcoin, stablecoin infrastructure. Stablecoins now have reached, I think it's 858 billion a day.
It's amazing.
Transaction volume for payments. That's a support structure underneath Bitcoin. And then now as DeFi is emerging, we're seeing a lot more companies that we can invest in. So we're kind of looking everything from trading systems. We invested in ETF products like Valkyrie. We have we've invested in Xmargin and Paradigm, which are block trading and margin systems. So we're a little bit more laser focused on the key ecosystem than lots and lots of different
David?
Token products.
This is similarly, we're deploying capital more like the infrastructure. So like fiat on-ramps. Right now we're looking at a company that's looking to launch the first Bitcoin ETF in Asia, for example, but and also DeFi on top of Bitcoin.
Yeah.
Those are some areas.
What I think what's really interesting is, for those, actually a quick poll while we can't see you. How many people in the room have hodled for more than 5 years? All right, all right.
I should raise my hand.
So I'd say a third, maybe a third. I won't even ask about 10 years. But I think that's the cutoff where it became kind of more popular. And look, if you've held for 5 years, you've made a spectacular return. But some of the investments in infrastructure and picks and shovels have actually been bigger. And I think from this point, investing in Bitcoin versus investing in the infrastructure and the ecosystem, I think it's going to be a toss-up as to where you're going to make more money.
I could address that. I think that's actually a super good point. I'm saying I actually think that it's probably one of the best times in history to be in venture capital.
Yeah.
Because if you look at the 90s, you have this analogy of voice, payments, consumer products, Amazon, media, Netflix. Those four areas in 90s have been totally, totally decentralized, basically like completely transformed and with huge valuations. Now we're going to see a transformation of four new areas: banking, asset management, and contract trade payments. And if you think about it, it's mind-blowing. Those four areas that we're going to are an order of magnitude bigger than the Amazon potential, than the Netflix. It's that much bigger. So if you just hodl, that's important. We all love Bitcoin. That's why we're here. Yeah. But the infrastructure, like like the investments we've made and Paul's made, I know for sure, they're all doing really well as like a derivative. Yeah. But it's like an equity investment is. For hodlers, it's like, oh, it's an equity investment. They don't really see the structure and governance side of it. But there's hundreds of companies that need to exist for our Bitcoin to make the impact that we have.
No, it's a real thing. And our funds at Morgan Creek Digital are 80% in equity and 20% in the liquid protocols, primarily Bitcoin, but a few other things, but mostly Bitcoin. And every day, every Monday when we have our meetings, we're having this discussion about, I'm on record. I tweeted out this morning at $250,000 sometime over the next few years. Yeah. I'm not like it's by the end of this month or July.
Yeah.
But so that's a 5x. 5x is really good. but we're looking at early stage companies in the infrastructure space where we might make 50x.
Yeah.
And that's just hard to, because I don't want to be disloyal to one of the loves of my life. But anyway.
Yeah, no, it's very true. I mean, that's the way that we sort of pitch it for institutional investors. They could be buying Bitcoin, and that's great. We think that it's going to go up to, $1 million, but at the end of the day, like all of these companies that you're investing into, again, it's supply and demand. I mean, as there's more use cases for Bitcoin, these companies are going to use Bitcoin, and therefore the value of Bitcoin should go up. So while you're investing into the ecosystem, you're really helping your Bitcoin investment. And at the end of the day, it's really about entry price. So you get in right now at, let's just say $50,000 of Bitcoin, you can go up 5x, but you invest into venture and you get in early at like a $10 million valuation and you hit onto a $1 billion company. That's,
all right, so when are you going to call me with those $10 million valuations? The last deal I looked at was 300 million pre.
Yeah.
It's like, anyway, Dave, what about when you're looking at those, because I think the other area that's big is that on-ramp, off-ramp opportunity, because again, it's the transaction volume where you make money. We were early investors in Coinbase, really happy with the public listing, but our clients are like, give me the stock, I want to sell. I'm like, why would you want to sell? They're going to do maybe twice the revenue they did in the first quarter in the second quarter. And everybody's like, no, that's impossible. The price collapsed. I'm like, duh. Okay, look at my shirt. Volatility, embrace it, right? You get more trading when there's volatility, not less. So how about the on-ramp, off-ramp, like volume plays?
Yeah, I mean, that part of the ecosystem is quintessential, right? And more particularly, it's not, the easy part is getting into the system, into the ecosystem. The hard part is getting out of the ecosystem, right? And so typically people, they'll buy Bitcoin, and if they want to move it, via remittance or, what have you, they will move into Tether, right? And then they'll convert their Tether to fiat at some off-ramp exchange for a matter. Like a company that I've been looking at is based in Thailand, and they do that. They're actually an on-ramp into Binance to go buy, Bitcoin and other alts there, but at the same time, they go back in their local exchange and then convert. And so, I think that the off-ramp piece is a really ripe opportunity right now.
Yep. Greg, if you had to pick one area of focus out of the, choose amongst your children, what are you most excited about in the opportunity set, in the pipeline?
Wow. Infrastructure on Bitcoin? No, it's good.
But which one?
I don't know. I mean, I think two of our key companies, right? A few of them, like we invested in Stablehouse, which is an on and off ramp around stable coins and infrastructure internationally. So every single one where it links to Bitcoin. So it's really that kind of like, I see the bridge to fiat as being one of the most important areas in the next 5-6 years.
Look, those stable coins, they're probably a fad, right? Yeah. You don't have the Fed talking about them or central banks in Europe talking about them.
Infrastructure around them, as CBCs come out, that's going to be infrastructure. And then also is, the formalization and structured products. Like if an ETF gets approved in the US, there's Valkyrie, then we also need to look at the companies like X Margin Paradigm, these kind of companies that are enabling large, like margining, and these things are starting to impact not just Bitcoin, but all product. I mean, all financial products. And there's this kind of link.
That exponential growth is, most people just can't deal with it because we're all linear people. Like if I say, what's 2 times 2? Everybody says 4. Great. How about 17 times 23? I'll wait. That's the limit of human intelligence. The average person can't do that without a calculator. So how are you at nonlinear logarithmic regression? Not very good. So the idea is if I take 20 linear steps, I get to the camera right back there. If I take 20 exponential steps, I go around the world twice. So the exponential growth on top of Bitcoin. So if we think of Bitcoin as TCP/IP, right? That's my belief, and a lot of other people believe that it's the foundational base layer of Web 3.0, of the Internet of Value, or the Internet of Money. The exponential growth on top of that is where? Where do you see that, Paul, in terms of biggest opportunity? Is it derivatives? Is it custody, administration? Where's that exponential growth?
Yeah, I think for us, like, we've invested in quite a few on-ramps.
Yeah.
And for me, I'm actually most excited about Bitcoin and crypto in emerging markets for me.
Yeah.
So we recently led the Series A for Pintu, which is the Coinbase of Southeast Asia, starting off in Indonesia. And so whether it's Indonesia, whether it's India, it's really untapped. And there's so many people out there that just don't have bank accounts. So they're going to be skipping the bank account and going straight to digital banking. And the easiest way for them to do that is actually getting into cryptocurrency.
Yep.
And we think that it's going to be tremendous. I mean, obviously you have to work with regulations. You have to work with creating a product and a use case, probably around yield, that makes a lot of sense for these people to come in and get into cryptocurrency and have it work better for them than fiat. But then beyond that, I mean, just outside of just the local on-ramp, I really think that use cases, like one of our companies, Vol, they're sort of like the a BlockFi for India.
Yeah.
But in addition to that, similar to BlockFi, they're offering a credit card where you can actually get Bitcoin back. I think things like that, whether it's spending or whether it's like sort of like brick and mortar physical, or whether it's like even retail, something like Lolly, which I'm a big fan of, where you get a little bit of Bitcoin back, and then once people have Bitcoin in their hands and they're sort of incentivized to learn more about it, figure out where to use it, things like that. I mean, that's the huge opportunity, trying to get more and more new people where in markets where it's needed most. I think that's the most exciting part, where this can get really, really big.
Well, I think it's interesting in the sense that we made a lot of money for our clients in Bitcoin itself, but we made 10 times as much money on our BlockFi investment as the Bitcoin investment. That's pretty cool. Yet I get hate all the time on Twitter. Oh, you're a sellout. That's CeFi. That's not Bitcoin. Not your keys, not your coins. How do we deal with that? We want to build out this ecosystem and this infrastructure, yet you got the maximalist who would say, no, if you don't have your Bitcoin, it's not real.
I think a lot of us are maximalists at our heart anyways.
Sure.
Especially on this panel, it might be surprising because we're investing in these companies, but like I said, the only way for Bitcoin to reach its potential is for the rest of the ecosystem to work. And I really like what Paul said, because the inclusion finance part of Bitcoin, which is like we're looking at Africa, we're looking at India, we're looking at these places where there's unbanked and there's people that can't like Venezuela, they want to transact in dollars or Bitcoin in something like that. And so you have the two sides of the spectrum. There's huge opportunity, like payments and remittance in these countries, which is nice that we're all global focused. And then at the top, we're actually in our fund, we're working with one of the global fund administrators, so we can actually now accept Bitcoin into the fund or accept stablecoin into our fund outside the banking system, but within the KYC regulated world, we can do that now. So that's a huge step, even at the top side of the institutional side. It's letting institutions and letting hodlers enter this kind of institutional ability. Like in the past, it's like, hey, can we send you a stablecoin? I think half the fund administrators have been like this, like, no, you can't do that. And that basically takes all these, these people like, and also they don't realize how you invest in venture, because when you invest in a token fund or a hedge fund, you give them all the money up front, and then they may pull it back at some time. But when you commit, 10 million to our fund, that money, we only pull that money from the investor on capital calls.
Well, the other area that is part of the ecosystem that is incredibly valuable, and I'm sitting next to Paul, and I talked to Dan 8 years ago when he shut down his macro hedge fund, gave back $1 billion, said, I'm starting a new firm. I'm like, oh, what are you going to do? He's going to spend the rest of my career focused on Bitcoin and blockchain. And I said I wasn't running drugs on Silk Road. I was not a cryptography student, didn't get it. So I missed that one. But he fund was $15 million. So imagine going from $1 billion, charging 2 and 20, to 15 million. Now $5 billion. That asset, Pantera, is very valuable. So two of our biggest investments were in asset managers. David, I know you're looking at an asset manager in Asia, right?
Yeah. That asset manager is like it's like an investment platform, and they're the ones that are looking to roll out that first Bitcoin ETF, and then subsequently other ETFs, TBD if it's going to be an ETH or or another top 5 token or what have you.
Okay. I mean, biggest miss of my career in venture was guy came to me before Grayscale was launched. Guy from San Francisco who was one of the early. He was the founder of the Bitcoin fund that did with Dan. He said, "Hey, I got this great idea. Let's create this public vehicle for investors to own Bitcoin." I'm like, nah, that was bad. So Greg, in asset management, are you guys looking at anything? I mean, other than people wanting to own a piece of you or a piece of you, or?
Well, I mean, asset management is a huge opportunity. I don't know the right investment yet.
Yeah.
I do know that all my friends that use wealth managers can't stand their wealth managers, and they're firing. I mean, it's laughable, but wealth managers are getting fired like crazy. Most of them missed the Bitcoin. Most of them were anti-Bitcoin for the last 5 years, and so a lot of people had their money with Goldman Sachs and Morgan Stanley and these really the multifamily offices, and they missed tons of this opportunity. And now they're coming back. We're in meetings with LPs, and they're saying, "Oh, I just changed my wealth manager."
Novo's got a great opportunity. They're a great business there, and we've got a digital index fund that's built for institutions, great third-party administration. But man, the resistance at the big brokerage level is still crazy. So again, Paul, if you think about this inclusion piece and the leapfrogging, the data is 2/3 of people in this world don't have a bank account. Just let that number wash over you for a second. 2/3 of the people in the world don't have a bank account. But 40% of those do have a cell phone. So we're going to enable them using the Bitcoin ecosystem through that cell phone. How would we do that?
Yeah, I mean, one of our companies that we invested into pretty early called Coins.ph in the Philippines actually had 5 million users on their platform. And that's, 10% of the country using cryptocurrencies in a digital form, and then being able to sort of onboard into Bitcoin and digital currencies allowed them to pay their bills, do peer-to-peer payments, all of that in a very seamless way, where normally they would have to go to the bank and spend a full day trying to make a transaction. There's no online banking over there in the Philippines. So, this was just a no-brainer for people to just get some exposure to Bitcoin, and then from there be able to just do their normal household chores and payments all through this. So this is just amazing, and I think that's going to be huge for the ecosystem, to just really bring this to a different level. And then, speaking of wealth managers right now, I mean, you're right, they have taken a long time to get interested in, supporting fund managers and different products, but guys like Goldman Sachs and Morgan Stanley, they're now itching to figure out a way.
Oh yeah, it's coming.
And so it's coming really, really
soon.
The
great wall of money is coming. So, anyone watch the Indy 500? Anyone watch it only because the Bitcoin car was in it, like me? Thought that was really cool. And part of the reason I watched it is we invested in Jack and Zap, and most of us in this room have no interest in selling Bitcoin. But we need to pay for stuff. So are you looking at anything in Lightning, Greg, or?
Yeah, for sure. I mean, with the stable house investment, it's really a way that people can make their Bitcoin create yields. It's like access to kind of DeFi yields. It's a way to pay for things, to earn, to switch to any currency in real time. Go back and forth. I think that's a big question: is how do we make our Bitcoin work for us? I also like something we did mention earlier is that some of these companies are starting to move to full Bitcoin balance sheets and operating systems. So the move into operating your business with a crypto balance sheet, like a Bitcoin balance sheet, or with some stable coins, where you don't even need your. I think what we're going to see is in the next 5 years a move to where you don't really need your bank, or you don't really. I mean, now we say laughing, but really, if we can start to transfer.
No, I'm sinister laughing. I'm not laughing. I'm sinister laughing because it's coming. And look, I tweet about it all the time. Long Bitcoin, short the bankers. And that's real.
It was very close, I think. And then also with your investments, being able to transfer your money to, and I'm not saying outside of the law. I'm saying outside of banks. I mean, you can still you can still send your money to like our fund or these funds or whatever, or to Stablehouse, still within KYC. It's a regulated entity. It still has all of the functioning things that the government wants. At the same time, it doesn't have to go through FedWire and ACH. And this whole thing about only sending money during office hours of New York is a disaster. You know, in Asia, it takes 2 days to clear a normal a dollar payment, whereas here it's a little bit faster. But still, I want to be able to send money, you know, on Saturday night.
Well, look, I mean, to that point, money over internet protocol.
Yep.
I mean, Alex is here, and some people say he coined it. Some people say I didn't coin it, but I might have done the Picasso, good artist borrow, great artist steal. But money over internet protocol is the greatest invention I'll see in my lifetime. And I plan to be here a long time, but it is the thing that's going to create so much opportunity for all of us to invest in. But in that money over internet protocol, do you see anything that you're really excited about, Paul?
Yeah, I mean, one of the companies that we just invested into is called Notional, and I think, especially during the bear market, it's going to be used quite a bit. In terms of getting Bitcoin in there, I think you could probably wrap your Bitcoin, which is basically created in sort of a Ethereum format. And what Notional allows you to do is decentralize.
I'm looking for the hook. I thought they were going to hook us if we said the E word.
Fixed term, fixed yield lending. And so, you can lend your cryptocurrency for sort of a fixed term and fixed yield, and be able to borrow stable coins and be able to use it for real world things.
Yep.
And so the great thing about that is you don't actually have to sell your Bitcoin, and you can still get money to be able to use it for other things. And the great part of that is Notional is a decentralized lending protocol. So it's not like a bank where you have to get it in before 5 p.m. at the end of the day. This is open 24/7. You manage your own keys.
Yep.
And it's all transparent, and there's going to be like probably better rates and incentives for you to actually use this platform because of just like decentralization, et cetera. So that's one of the use cases I think is
last
super
15
exciting.
seconds each. The big idea that no one's talking about.
The big idea that no one's talking about. Well, I think that's the Bitcoin stablecoin interaction.
All right, Bitcoin stablecoin interaction.
Off-ramps in Southeast Asia.
Off-ramps in Southeast Asia.
I think insurance. I think that's
insurance.
Really
awesome.
And
mine
is my
is
answer to Paul's answer.
As amazing and fantastic as this conference is, and the guys deserve all this credit, they didn't give y'all Bitcoin whale socks from my friends at Mount Socks. So you should have got that in your bag, but I got some. So anyway, thank y'all.
Thank you very much.
Hey, everybody. How's it going? About halfway through the event here. Want to feel that energy, get you guys pumped up. We're going to have a couple great announcements. So transitioning from doing some panels, heard a lot of conversation, heard a lot of insights. Back to back here, we're going to have a couple great announcements coming up. So appreciate you guys staying tuned for that. Also want to remind you guys on Twitter, hashtag Bitcoin 2021. If you guys want to take pictures, tweet about it. Event organizers would be very grateful. But again, coming up, got some announcements. Bitcoin's hidden treasure is coming up. Mr. Takeaki Kato, Global Head of Sales and Trading at Bitflyer, will be coming up shortly. I'll be giving you a special announcement, and we should all stay tuned for that. So, all right. Well, all right. I guess I'll transition to talking a little bit about, oh, here he is. Takeaki, take it away.
All right. Thanks for giving us the opportunity to announce this here. So my name is Taka Kato. I work at a cryptocurrency exchange called Bitflyer. Obviously, I'm here from Japan. Japan is the land that's giving you the sushi and sushi swap, the Shiba Inu in the dog coins, which I don't even want to go there. And of course, the name Satoshi and Nakamoto. So again, there's obviously some ties to Japan and crypto. But today I wanted to share with you some reasons that it may be worth, again, focusing more on Japan and the Japanese crypto market going forward. So let me just quickly start with Bitflyer. A little bit of color of who we are. So Bitflyer is Japan's #1 Bitcoin exchange. And it was the world's first exchange to be licensed in Japan, Europe, and the US. We currently trade roughly about $280 billion as of the first quarter. There's AUM of 5.3 billion with 2.5 million customers. We are licensed in 48 states, including New York. So that's a bit about us. Now, Bitcoin in Japan, I don't know if many know, but historically Japan has been Bitcoin's second largest market. And it's the only country where it is actually legal tender. But having said that, I still think there's a lot of room for growth. And the reason for that, one of them is this stat on the right here, where if you look at the percentage of household financial assets held in cash and deposits, it's 54% in Japan. So by comparison, you're looking at 35% in Europe and 13% in the US. Now, I'm sure a lot of people have, the notion of, fiat cash as a store of value and how great that is. So unfortunately, that narrative hasn't really hit Japan in my mind. So I think once that happens, it'll be quite interesting. But Japan's market is already this big without this narrative having taken hold. Now, Bitflyer is, we think, Japan's gateway to Bitcoin. So we've developed an ecosystem, a lot of products, and work with some of the largest companies to push the adoption of Bitcoin in Japan. So if you think of Bitcoin for many Japanese, it naturally assume Bitflyer. We trade about 57% of all the BTC yen volume in Japan. Now, just to give you guys an idea of how that fits into the sort of greater picture globally. Japan, how big is that market? Historically, many global players have struggled to break into Japan. There's a lot of regulatory constraints and an outdated banking system, which makes it quite difficult. If you look at the size and the scale, and unfortunately you can't see the lines too well, but Bitflyer is roughly the same scale as a Kraken. So it's not a small market by any means. But what's more interesting is that there's some interesting trading opportunities presented here. And the reason for that is because our markets until now have been very much dominated by retail flow. So, over half of our flow in our exchange is all retail. And today, what we're here to announce is that we're finally opening up the gates to our market to a much wider audience, especially the US investor. So today I'm introducing cross-border trading, which is as the picture shows, the ability to trade from the US into Japan, which we hadn't had until now. And so US-based clients can now trade our BTC yen market directly through, and also our BTC USD market as well, through a BitFlyer USA account. So that literally just launched today. And we're doing this with the lowest fees in the US. So that is it. We hope that if you have any questions, I'll be around. Some of my colleagues will be around as well. Please reach out to us. But we hope to see you guys and welcome you to Japan through the doors of Bitcoin. いらっしゃいませ.
All right. Give it up for Takeati. Going global, a great reminder that Bitcoin truly is a global market. We'll have 12,000 attendees here tomorrow, many from around the world. Really would invite you all on behalf of the organizers to take the opportunity to have some more conversations, talk to people, and learn about the financial systems around the world and the problems we're trying to solve. And keeping that theme of going global, next we've got a really great speaker. I hope you're all excited for him. Really needs no introduction, but I'll introduce him anyway. The former presidential candidate in 2020, Brock Pierce, is here to talk about Puerto Rico. Brock, take it away.
Good morning, Miami. Wow. It is so nice to be back in the circuit or circus again. As social creatures, we need these opportunities to get together. So many new faces, along with those that are familiar. Wow, what an exciting time. I estimate that something like 30 million Americans have Bitcoin, probably 300 million people internationally. This is going mainstream. We're watching even the biggest financial institutions like JP Morgan, reluctantly but finally, saying, oh wait, something is happening here. That was a tough pill to swallow. Morgan Stanley, Visa, MasterCard, PayPal, Square. These major institutions do not attach their reputations or brands to a movement like this lightly. This is a major event. And look at what's happening here in Miami. Thank you, Mayor Suarez, for basically saying, I embrace innovation. I want Miami to be the capital of capital. We want innovation here because the future belongs to the bold. The future is going to happen to us or with us. So let's get involved. Thank you, every single one of you, for being here, for being part of this movement. Because we have the ability to change the world. We're doing it right now. I just came from Dubai as well. Amazing to see another place that is adopting and saying yes to innovation. They don't have oil money. They're one of the 7 Emirates, but that entire place has been built through outside investment, economic development. And right now we're watching the cities of the future emerge. And it's hard to be bold, to be a contrarian, when everybody's going this way, to say, no, I'm going to go that way, to see something different. And that's what we're seeing from places like this. So grateful for it. For those that don't know me, I live in Puerto Rico. I've been down there for about 3.5 years. And so for me, I'm not in pursuit of money anymore. It's how do I make an impact in the world? As I look around and I question kind of the status of things. That's why I ran for president of the United States, because I see something wrong. And I see a lot of people that don't know what's going on. And it's I'm willing and able, and so I have a moral obligation to step up and do something. And so Puerto Rico, like Miami, offers an incredible quality of life, combined with tremendous opportunity. But what drives me is impact. It's an opportunity to positively impact the lives of others. About $2 trillion, it was 3, but about $2 trillion of wealth has been created over the last, call it 5 years. This is the fastest creation of wealth in a short period of time that the world has ever seen. We're not far away from a majority of the world's billionaires having made their money from Bitcoin. that wealth being distributed all over the world because it's the democratization of opportunity. This is something that has been available not to the select few, but open to everyone in the world at a time where we need wealth in the hands of new people. This is the greatest wealth transfer in the history of the world. And for people that made their wealth over generations or decades, there's a sense of entitlement of, oh, this is mine. But when it's come faster and easier, we're willing to invest in things that we think the world needs right now to facilitate positive change. And that's, again, why I'm in Puerto Rico. It's something that is just incredibly rich in its history. If we go back in time a bit, you have to remember where all of this came from, North and South and Central America. Obviously, it was here prior to Christopher Columbus and the conquistadors. But in 1492, when he sailed across the Atlantic Blue, he first stopped in the Dominican Republic, but then in Puerto Rico in 1493. And all of that development of what we called the New World, which wasn't new, but new to them, started there. And it was Ponce de Leon who then, in search of the Fountain of Youth, discovered Florida, the place where we are now. So rich in history. Old San Juan has literally the first formal road ever built in all of the Americas, right there in the center of town. Incredibly rich with history, something I strongly encourage those of you to come down, check it out, see what's happening. Incredible movement. I moved there right after Hurricane Maria, during the longest blackout in American history, to go to the part of the United States that historically had suffered the longest and the most, to see what I could do to make a positive impact. Supported about 200 different charities on the island, economic development from innovation, energy, food security, impact in every way I possibly can. And right now, because of COVID, it's really facilitated this virtualization or decentralization of the workforce, that you can work from anywhere. And now that we can do that, where will you go? Obviously, Florida and Texas have benefited greatly from it because, again, we want quality of life. But we want to keep some of what we've made. We want good tax structures. Obviously, Florida not having a state tax. Puerto Rico, very interestingly, because governments only have a couple of levers. But one of those are incentives. What do you incentivize? Back to how Dubai was created. Georgia, for example, has been bringing a lot of the film industry there through their economic incentives. How do they subsidize and do things? Puerto Rico's got a very interesting incentive, certainly for those of us in this space that have the freedom to work from anywhere. They offer the Act 60 decree, which provides 0% short-term and long-term capital gains, and it's exempt from the IRS. Remember, the United States of America taxes us on our worldwide income. So when you leave the United States, you still pay U.S. tax. But because Puerto Rico is a U.S. territory, you can't have taxation without representation. There's some really interesting economic incentives there, which also exist for the locals. If you set up a business there and your businesses are exporting services, your intellectual property is there, you're taxed at a 4% income rate. And then there's all sorts of stuff from there's economic incentives on top of incentives on top of incentives, because the place is in need of a lot of economic development. It needs to bring in a lot of foreign or outside investment. And we're seeing it, this is certainly, Miami, I believe, this is the most popular place right now in the country. And I don't think this is just going to be a temporary thing. I think this is going to have a long-lasting impact. Miami is carving out its place in the world as a city of the future. We're watching these new capitals emerge. Singapore, obviously, over in Asia. Berlin's got quite a community if you haven't checked these places out. But how governments handled COVID and the lockdowns, I mean, you can't lock us up in cages, for a year and expect us to be content. Clearly all of us here, we're ready to get back to living our lives, and we want to get out there. And, the places that open up and say, we're going to let you live, are going to be the biggest beneficiaries of this, Miami certainly being one of them. I want to encourage everybody, to figure out what it is that you can do. What is your why are you here? Why are you here? And I don't mean why at this conference. Why are you here on earth right now? What is your purpose? Asking yourself, what are my gifts? What are my skills? What are the skills that I've developed and honed over the course of my life? And how can I utilize these gifts to make the world a better place? Living for something more than me. Because we're ultimately in this together. We've got one planet we all share. And this place, this world is clearly in trouble. It doesn't take me to tell you, you can feel it. And we have the ability to make a difference. Each and every one of us has an important role to play in the change in the world. Teamwork makes this collective dream work, and I am so, so glad to be able to play this game with each and every one of you. Keep up the good work. Enjoy your time here in Miami. Connect with everyone. Find out what they're doing and see what you can do to help them. Thank you, David Bailey and BTC Media, for bringing us back together again, having the courage to throw this type of event. As everybody else is afraid of gathering, it takes courage. Again, the future belongs to the bold. And so thank you all for showing up. Enjoy Miami, everyone.
What's the matter? I am at Mexico. This is 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 Mexico. Viva México, cabrones. This is Mexico. This is Mexico. Mexico.
Hey, wow. Another great example of just the expansive view of the industry and where we're going. So again, a big thank you to Brock Pierce. Now we're going to turn it over to mining. So we've got a panel on Bitcoin mining. One of my favorite topics in the Bitcoin space. Really amazing when you think about it. A system that allows anybody in the world to compete for the new money issuance of the Bitcoin protocol. Every 10 minutes, 6.25 Bitcoin are being created and distributed around the globe through a computer system. Really quite amazing stuff. People may not know that you used to be able to mine on a home computer back in the day, the CPU of your computer. You could buy a little USB stick this big. It could get you 50 Bitcoins. So mining really quite an amazing story, and it really speaks to the advances of the industry, how far it's come, that this hobbyist community is now in data centers, some of the largest in the world. And another fun fact, Bitcoin mining, if you added up all the computers, one of the largest supercomputers in the world. So when people like Adam Back describe Bitcoin as a wonder of the world, that is a great data point. Anyway, I'm going to turn it over to our great panel here. We've got a lineup of experts who are really going to dive deep into Bitcoin mining, the next industrial revolution. Forget the FUD that you might have heard. These guys are going to give you the take on how they're seeing the industry and how they're going to see it develop. First up, we've got Ben Gangan, Chief Mining Officer at Bitfarms. Welcome, welcome to the stage, Ben. Next, we've got Amanda Fabiano, Head of Mining at Galaxy Digital. Next, Kevin Zhang, VP of Business Development at Foundry Digital, up-and-coming firm. Next, we've got Russell Can, Chief Client Success Officer at Core Scientific. And last but not least, you may have recognized him from the cover of Forbes magazine, Matt Rozak, Chairman of Titan. Matt, floor is yours.
Can't see shit.
All right. Thanks, Peter, and great to be here. So we're going to talk about mining today. And I remember when I first read Satoshi's white paper, I started to dig into this mining component, and it was like the first thing that came to my mind was like this golden goose. this golden goose that drops these golden eggs called Bitcoin. And I think it's like very apropos to how it kind of operates. And then today, fast forward to 2021, that golden goose drops 900 Bitcoins a day. That's about 35 million a day and about 12.5 billion annualized. So the eggs are pretty amazing these days. So let's quickly go up and down the panel and give a brief introduction, and then we're going to kick into the discussion. So Ben, why don't you kick us off?
Sure. Hi, I'm Ben Gagnon. I'm the Chief Mining Officer for Bitfarms. We are a publicly traded Bitcoin mining company based in Quebec, Canada, currently traded on the Toronto Stock Exchange and will be listed on the NASDAQ in a couple of weeks. We have about 1% of the Bitcoin network on 69 megawatts of green hydropower. And I've been in Bitcoin since 2010, and I've been mining since 2015.
Hi, I'm Amanda Fabiano. I'm the head of mining at Galaxy Digital. Galaxy Digital is a diversified financial service company with 5 business lines, and mining being one of them. I have been mining since 2016, 2017 timeframe. Before Galaxy, I was the director of Bitcoin mining at Fidelity Investments.
Hi, I'm Kevin Zhang, the VP of Business Development at Foundry Digital, which is the 4th wholly owned subsidiary of DCG. We are DCG's play in the decentralized infrastructure. We focus on both proof of work and proof of stake. My history and background is in building large-scale mining facilities all around the world, starting off in North America, and super happy to be talking about Bitcoin mining today.
I'm Russell Cannon with Core Scientific. At Core, we are a large infrastructure company. We operate hundreds of megawatts of mining capacity for ourselves and for others. We are a big hosting provider in North America, and we operate in multiple states.
Awesome. So we're going to kick off with kind of 4 topic areas. Is Bitcoin green? Talk about China. Talk about the financialization of Bitcoin. And then kind of innovations, like what's around the corner in this Bitcoin mining space. So let's kick it off on, is Bitcoin green, right? We've seen in Bitcoin the fundamentals being very strong, but the narratives being kind of weak. And we saw that playing out with Elon and a lot of the stuff that was happening in terms of, is Bitcoin green? And I've seen statistics going from 50% to 76% using renewables, so kind of hydro, green energy, etc. So Bitcoin is already kind of green. And then if you kind of fast forward it, there's this Darwinian incentive for you to go out and find the cheapest source of energy, which is typically green. So are we just on a cusp of a super cycle of green energy investment, a new customer for the renewable industry in Bitcoin? How do you guys look at this?
Bitcoin is very, very green, especially compared to most other industries. We have a lot of different incentives that Bitcoin brings to energy markets, and that's the most interesting part. It's the reason why Bitcoin got so big in China was because they had all this excess hydropower in Sichuan that didn't have any other industrial use. And so Bitcoin miners came in there and soaked it up. There's no transmission lines that carries it to the coast, but they built all this infrastructure over several decades. So most of that electricity was actually being wasted for a long, long time. And Bitcoin miners actually finally monetized and put it to good use. I'd say the biggest waste of energy and the least green energy is the energy that's created and destroyed and wasted. That's a big problem. And what Bitcoin mining does is it provides incentive to avoid that. So one of the things I think is most interesting about the energy debate is that you never hear about Bitcoin mining's incentives for flare gas mitigation or vented gas mitigation. This is by far the most economical and powerful technology for reducing emissions in the world, bar none. So if your goal is to reduce emissions, then Bitcoin mining is the way to do that through these flare gas and vented gas situations, which are ongoing and pervasive. But you won't see anybody talking about that because it's not the narrative that they want to put forward.
Yeah, I would say what usually ends up happening is that you can see how much energy the Bitcoin network uses at any time. So we can audit the network and say, hey, Bitcoin uses this much energy. And that amount really scares people. But when you compare it to other industries, it's really difficult to see how much energy each industry uses. And it really does come down to the utility of Bitcoin. Do we think that Bitcoin is useful? And if you do, the energy usage is something that you can get behind. I agree with you on the gas flare mitigation. And how I look at it is, like you were saying, Matt, over time, you have to be on the low end of the cost curve because you are in competition with every other Bitcoin miner. So if you are on the low end of the cost curve, which is, you know, things like flare mitigation and, you know, greener sources of energy, you're going to win as a Bitcoin miner.
Yeah, to piggyback off of what Ben and Amanda said, I absolutely agree that Bitcoin mining's got this ruthless drive of cost efficiency. And I think what's really hurting the narrative is actually lack of transparency in the data. Historically, many of the mining pools have not been the most upfront and forthcoming with their participants and where all the mining energy mixes are coming from. And if you were to dig into the data, you'll see that majority of it is renewable. It is a lot of stranded power. So part of changing the narrative is actually getting access to that data, putting out better research. I know Galaxy's doing a great job of that. Bitfarms, all of your energy mix is hydro.
Yep, 100%.
But most people don't know this, right? So at Foundry, we do have a mining pool, and we're looking forward to putting out our research and the data that we're getting access to kind of fight back against this energy fund narrative.
So Matt, at Core, end of this year, we'll have 550 megawatts mining. Not a small amount. And next year, it's going to be a lot more. So I can speak with some authority on power and power infrastructure. And you guys have nailed it. When we deal with TVA, Duke, Southern Company, all those guys, they have to sell us power at such a low rate. The only way they can produce it cheap enough to sell it to us comes from carbon neutral. We're 100% carbon neutral, by the way. So 550 megawatts, 100% carbon neutral. That's because it's got to come from renewable. It might can come from nuclear as well, which is also a very inexpensive source of power. And those are really the only two things. So if I look out into the future, and this is just me talking, if I look out into the future, you're going to see Bitcoin mining leading the way on renewable energy. And it's going to be folks coming in and building a 300 megawatt solar farm and then pulling off the grid at night. And because during the day, the rest of industry uses power, so the solar farm will fund. You're going to find that because, as Amanda said, to be competitive globally on the Bitcoin network, your power has to be cheap. So we're naturally going to be green, not because we want to be, because we have to be. There's another important point, and it played out, regrettably, in Texas in the wintertime, and that's grid stability. You know, at Core, we've now been dealing with some of the largest power producers on the planet, and after a few years, they've learned that we are their grid stability play. So instead of building a natural gas peak plant in order to make sure that, you know, Charlotte Banking Center has enough air conditioning in the middle of July, they can actually run much more efficient hydro, solar, wind, not North Carolina, but, you know, they can have those much more efficient systems and then curtail. And at Core or anywhere else, when you're crypto mining, you can curtail without it costing someone lives. They did it in Texas. There was 400 megawatts of mining going on in Texas when the winter froze up. Those 400 megawatts all turned off. All that power went back to the grid. Now it was used to cycle through, you know, heat and everything. But that grid stability play is another piece that we need to talk about. And at least in North America, we can use that. And the big power companies, the big power infrastructure companies are realizing that now. So instead of building all this peak plant and having all this peak capacity or even buying off the grid, they can have the most efficient system possible and then work with the big crypto miners to do that.
Are power companies waking up and smelling the Bitcoin?
Yeah.
Absolutely. Yes.
Yep. I think there's going to be two trends that we see. I think we'll see more transparency as more miners grow into North America. So even for the public mining company announcements that they've had, it will account for over 20% of the network, the current network. And, you know, all the public mining companies are sharing what they're doing and what their energy sources are. So in North America specifically, I think we'll see more transparency. And then I do think that there is going to be this like natural convergence of energy and Bitcoin mining, those two industries working together. I like we're already seeing that happen, like a lot of energy companies calling us and asking about Bitcoin mining.
So how do we square off the Elon Musk tweets on Bitcoin's mining dynamics? It's like it's too good of a conspiracy to not like think this through, whereby, oh, it's not green, I'm going to pull back. It creates this super cycle of Bitcoin being green, investing in renewables, creating a super cycle for renewables thanks to Bitcoin. And yeah, doesn't he sell solar panels and battery packs and the rest of it? Kind of an interesting conspiracy theory. I kind of love that.
He's a smart guy.
Yeah. So let's switch gears to China. So in 2017, the Chinese government pushed a lot of exchanges outside of its borders. That's one of the reasons Binance benefited so well during that time frame, because it captured a lot of that volume. Now, there's an interesting, eerie similarity with mining, where the Chinese government is saying this is not no longer an activity that is condoned. And so that's getting pushed out. So what's happening kind of on the ground in China, and then how do you guys as practitioners and professionals in this space absorb some of that energy, whether it's hash rate, money, other dynamics?
Yeah, there's a lot of interest coming out of China right now for hosting inside North America or inside Europe. They're looking for other jurisdictions, and I think this is a boon for Bitcoin. And it brings up a really interesting point with regards to how the market works. The Bitcoin price is basically unlimited potential. It can do whatever it wants, right? But with the hardware, it's very, very fixed and linear in terms of how quickly that can be manufactured, how it can be distributed and installed and turned online and be made productive. We have huge, huge timelines to do that now, especially with COVID. So I think there is an opportunity for North American companies and European companies to start absorbing some of that and bringing in these Chinese customers. They'll have some geo-diversification in their risk portfolio by moving their equipment elsewhere. But at the same time, I still find it hard to believe that mining will stop in China. It's been going on there for so long, and it provides such a great economic value to the communities that it's operating in. It's really hard to imagine that the local governments are going to want to shut that down.
So from my perspective, I've been talking to a lot of Chinese miners that are thinking about moving hash rate offline. I think that there's two things that will be risk factors for them. One, when you import machines from China, there's a 28% tax for it to come to the US, which is a massive amount of money when you're thinking about running a mining operation. And then two, usually the co-location costs in the US are a little bit higher than the co-location costs in China. So I think that those two things will be limiting factors. But I still do think that there will be diversification, and it will be eventually good for Bitcoin. If we think about what happened a couple months ago when the coal plant turned offline, about 20% of the Bitcoin network shut off. And it was all because it was, mining machines in China, and all, going to that one source of energy. So I think that it would be really great to have more diversification on Bitcoin mining, but I think there are still some challenges for, Chinese miners to face when they're coming to North America.
Yeah.
Yeah. So the China banning Bitcoin, banning mining, it's a fascinating topic because it's very cyclical. History repeats itself. So what we typically see is anytime retail speculation and retail interest picks up in China, China has to flex that they are in control. That's the kind of the basis of the government's kind of control. So as such, this was a couple of weeks ago, CCTV, which is the state-ran news channel in China, broadcasting to billions of people, when they were doing a 30-minute segment on doggy coins and the thousands of percents of returns you can get. I think that's when it was kind of a signal that, okay, the central government, they're going to come in and issue some announcements on their stance on Bitcoin. So what we have now is the central government is saying crypto and Bitcoin these currencies, they aren't backed by anything, they're not real assets, this and that. And as such, the intense amount of hardware and energy consumption used to support the proof of work protocols, that's a waste of energy. That being said, the local governments at the 4 main provinces that mine, Inner Mongolia, Xinjiang, Sichuan, and Yunnan, they've approached it all very differently. Mm-hmm. So Inner Mongolia, they actually have banned mining, right? It's predominantly coal-driven up there, and it's not so much on the energy side. I think that's more the PR take for why they're closing mining up there. The real reason is because when they built all these high-tech data centers and facilities, and they wanted to attract more kind of blue-chip business, and the FANG companies to go in and build their data centers, what ended up happening was you had Bitcoin miners building at very, very low cost and hardly creating any jobs, making these very cost-efficient mining facilities. So that was one of the reasons that they actually banned mining in Inner Mongolia, not because it was using so much coal power. Now, the real question now goes back to Sichuan. So right now, we're at the beginning of wet season in China. This is where hydropower becomes much more abundant and energy prices go much lower, and which supports all the different points we're talking about earlier. The central government, once again, says they want to kind of limit and kind of control Bitcoin and cryptocurrency activities, especially with mining. But the Sichuan locals, they have all this abundancy of power that's otherwise stranded. There's somewhere between 3,000 to 4,000 hydro dams in Sichuan. Mm-hmm. And that's a significant amount of power that goes to waste, especially during wet season. So the Bitcoin miners, they're sitting by, waiting for further announcements on whether or not Bitcoin mining actually is allowed, because there's definitely miscommunication and disconnect between the central government and the local.
And they have until like September, October. So one of the areas of time that I'm going to keep an eye on is that time frame, September, October, to see what happens with the hash rate and if it gets distributed into different places.
Yeah. The one thing I will add is like the hash rate right now is actually a little bit lower because the wet season's been slow to start. So it's a combination of are they actually allowed to mine or aren't they allowed to mine, and also the rain has been actually slow to come this season.
Yeah, Kevin covered most of the important points, especially about the lift and shift that happens, which goes back to the green Bitcoin thing. In China, they have so much hydropower, and they're chasing that excess power Ben talked about. So we got to realize that's a lot of green energy there. But I also want to say this: we don't want China to ban mining. We need Chinese mining, just like we need North American mining, we need Russian mining, we need European mining. For the Bitcoin network, being distributed globally is what we want. We just don't want as much mining in China as we've had, not 70-something%. So, and we see that migration happening right now into North America. And as we balance out the global Bitcoin network, it's actually better for the whole Bitcoin network.
Yeah, helps with decentralization.
Yeah.
Just to touch on that really quickly, we have the same situation in Quebec that we have in Sichuan. The entire province is loaded with hydro dams that have been built up over several decades, and a lot of that is excess power too. So that gets transmitted on high voltage electric lines, 1,000 miles down to the US, and when it does that, it loses huge amounts of electricity in that transmission, right? That is complete waste that we can do nothing about, right? At least here, we're taking advantage of it, we're monetizing and using the full amount locally before it gets transmitted and wasted.
So Bitcoin mining has gone from hobbyist, you plug in your laptop and you mine, maybe you buy mining equipment, you make a little bit more, you buy more mining equipment. So it went from hobbyist to kind of more professionalized, where people did this at scale. And now it feels like it's getting industrialized. There's 20 public companies that are mining Bitcoin. There's probably another 10 filed or kind of around the corner. So the industrialization of Bitcoin mining is upon us. And in many ways, you take a step back, it's a massive project finance exercise. Get capital, get a facility, get the stuff, plug in the power, mine Bitcoin. So a lot of that stuff is pretty traditional in the way you piece all that together. It seems like people are figuring out the power side, right? Go where there's cheap power. They're finding, whether it's Wall Street, private equity, to find the capital. That used to be a big struggle to say, I need money to buy this toaster to plug it in and mine Bitcoin. It was, 5 years ago, it was a little strange discussion. But now, it's kind of a well-known financing dynamic. It seems like the hard part is getting the toasters, getting the miners. So the supply and demand dynamics are kicking in. What do you guys think about when you manage access to mining equipment?
I think mining is a very strange economy of scale. It's a very strong U-shape where it makes sense at a really, really small scale where you're taking advantage of waste or excess or free electricity in small capacities. And it doesn't make sense at all in the middle because it becomes a really capital-intensive game right now. And the people who have the best access to capital are large-scale firms and institutions. And this is what's really driving the industrial side of it. So it makes sense at the small end, doesn't make sense in the middle, makes sense at the very large end. And right now with such high demand for equipment, what we've seen is that the price for equipment has drastically outpaced a lot of the times the actual price for Bitcoin. And that's because people understand what that cash flow is worth going forward, and they're incredibly bullish about what that means for their profitability. So, even with old equipment like S9s, which were largely written off, that had a 30-fold increase in price, while Bitcoin went up, 6. So there's a huge opportunity there, and if you're going to play that game, you really do have to have access to capital, and that's where groups like Foundry and Galaxy are starting to come into play. And groups like ours, who are publicly traded and audited by a Big Four firm, we're going to have greater access to that capital than a small firm that just started up and is trying to get financing for $5 million with no experience and no history.
So I want to add a little bit to what he's talking about there too, because you asked about miners. Right now, you've got Bitmain and MicroBT. They've done a good job of tying up semiconductor manufacturers. They really have. Now they're taking all these huge deposits, a lot from North America, and they've tied up those semiconductors. So this is my personal opinion, where miners were the scarce thing, we were just talking about backstage, for the next 6 months and really going into 2022, the actual infrastructure to do the mining is going to be tough. Because if we have to build out 100 megawatts of steel and transformers and copper line, we're having to compete with everybody else on the planet that's trying to do that right now. And the pandemic created and if those in the construction business here can tell you this, material costs have gone up tremendously, but it's also increased the timeline.
Great point.
So like right now, if I look even 6 months in the future, machines are there. They're expensive, but they're there. It's the infrastructure and the hosting capacity that's going to be in very tight demand going in the rest of 21 into 2022, and that's without Chinese mining moving out of China and into North America. So you compound that when we have someone calling saying, I want to move 30,000 miners there, and you can say, well, I can't turn those on tomorrow because those transformers just aren't available. And the number of companies in the world that make 50 and 100 megawatt transformers for substations, you can count them on your hand. Like, those things just don't happen. You have to close down bridges to move those things and interstates. So, those of us in this business, we realize that, but I don't know the rest of the world does. Like, that is a serious undertaking when you have to do that. We have a guy named Wes Adams at Core that specializes in it, and that guy's been building stuff for 30 years. Like, he knows what he's doing. Like, it is a tough job.
And must be frustrating if you have miners sitting on a pallet not plugged in because you're waiting for that. That's
They're like bananas. They're rotten.
A little unnerving, right?
Yeah.
And then, Kevin, you guys have done an amazing job filling the gap with a lot of financing for companies that are aspiring to scale their mining operations. Tell us about that.
Yeah, absolutely. So this was early 2020 when the market's pretty bearish and capital's very dry. So at DCG and at Foundry, we realized that to really help decentralize the hash rate, bring more of it into North America, we have to step up, leverage our balance sheet, our capital, and alleviate a lot of the delivery and execution risk. And help capitalize miners, the credible good actors like the Bitfarms of the world, the Cores, to help them finance and bring mining equipment from China over here to North America. I think Russell touched on a key point, which is now that we've, for the most part, solved the financing and the capital financing piece of it, the trickiest part is the timing, right? The lead times for when you get your equipment, you have to order 6 to 9 months out. And then when you're building any facility or site or expanding existing ones, these are very long lead times in North America. Like, everything has to be done above board and by the book. And as such, you have facility studies, system impact studies, all these that take months and months. So coordinating the timing of when you're placing your orders, the delivery of the miners, like you touched on, Matt, nothing's more painful than having miners sitting on the floor and not plugged in. So that's the kind of the big key thing that everyone has to focus on.
The one really interesting thing when you think about financing miners, because Galaxy, we do it too, is there's miners like Bitfarms, right? They'll buy machines future out. And a lot of people want financing now for it, but what's your collateral, right? So you're like, here's money, here's a lot of money for machines that might come 6 months from now. So, that's one thing that has been difficult for us to overcome. So we switched it, and so that's why we started to buy miners, and then we use those miners to, shuffle through to, mining facilities that want more machines, because it's a little bit different than traditional financing.
Yeah, and I remember when you were at Fidelity and Nova was smart enough to bring you on board, and you're solving a lot of pain points on that financing, but you're also getting really deep customers, because all the rest of the financial services that Galaxy has, you can start plugging into that. So it kind of takes us...
ordering machines at Fidelity was a fun one. Yeah, for sure.
No doubt. And so innovation-wise, what are we seeing around the corner on mining? At Titan, we're building a hash rate protocol to create hash rate financial products and derivatives. But that's still kind of on the horizon, right? That's a future state. What are you guys seeing around the corner in terms of innovation in mining, whether it's in infrastructure or anything else? Like, what are we going to see in the next 3 to 5 years?
I think the financial markets are really going to get into mining in a big way. This is the most predictable cash flow in the world. And we have a very, very, clear path forward for 4, 10, 12, 120 years as we get down to the end of the block reward for mining. You can think of Bitcoin as like the atomic clock of finance. There's never been such a predictable asset. And at any point in time in the future, within a small degree of precision, exactly how many are going to exist. And that's never happened before. Now there's some variation with regards to what that's worth, but the finance groups are going to start tearing into this, and they're going to start creating all sorts of interesting derivative products based on that cash flow.
And it'll help you as a miner to manage cash flow and risk and other things.
Absolutely. And it'll give investors greater exposure and decentralize the market, via this proxy.
Short-term immersion, longer term, it's going to be more purpose-built or purpose-acquired renewable energy sources close to the mining farms. You're going to see miners locate very close to the sources, whether that's a hydro dam, a solar complex, a nuclear plant, or whatever, so you don't have all the loss coming out of the generation. But your immediate stuff, you're going to see, in my humble opinion, you're going to see a lot of folks moving into immersion. It's gotten affordable this generation. It's going to get more affordable. And one of the biggest things we deal with in our industry is heat and having to use passive air to try to cool it. Immersion is going to help solve that problem. And going back to what you said too, we're just going to continue to see the industrialization of it because it just drives efficiency. Yep. A client can call me and host their miners at Core for way less than they can host it in their garage because we're buying the large renewable plant versus it being 12 or 13 cents to run their house power.
So cool. All right, well, we're out of time, and please help me in applauding our panel.
Welcome back. A sobering reminder of where we are today with the traditional financial system and in context what we're trying to build. But maybe taking a step back from that kind of FOMO, appreciate you guys all being here and starting your Bitcoin journeys. Just a reminder that it is a start of a journey. And do your research, take your time, test it out. Do remember to check out the great products and services that you're going to see in the booths around the conference over the next couple days. For now, I'm going to turn it over to the panel that is going to discuss a little bit about Wall Street and the Bitcoin world coming together. The title of this panel is going to be the elusive Bitcoin ETF. No secret, we're still waiting for a Bitcoin ETF in the United States. Some in Canada, but there is hope for the future. We're going to have this great panel here. First, Ryan Lovar, General Counsel at Wisdom Tree. Next, we've got Matt Hogan, CIO of Bitwise Asset Management. Steve McClurg, CIO of Valkyrie Investments.
Oh.
Thanks for coming out. Next, Representative Warren Davidson, active congressman from Ohio. Warren, welcome to the stage. And finally, moderator Anne Marie Tierney, senior strategic advisor at the Chamber of Digital Commerce. Take it away, guys.
Well, we were talking in the green room about the wonderfulness of being on a panel on legal and regulatory issues. That's not the last day in the last slot. So we're pretty excited to be here. I've got a great panel here. We're going to talk about why the SEC is taking its sweet time to get a Bitcoin ETF approved, and maybe just go down the line and everybody can introduce themselves really quickly, and then we'll get started. Representative Davidson?
Congressman Warren Davidson, I'm from Ohio. I am the ranking member, which means I'm a Republican in the current Congress, not a chairman, which is currently the Democrats in the House, of the FinTech Task Force on the Financial Services Committee, currently chaired by Maxine Waters.
Yeah, hi, I'm Stephen McClurg, the CIO and co-founder of Valkyrie. Valkyrie is an investment management company looking to launch ETFs and trust in the space. Spent a lot of time in the ETF industry as well as the institutional investment industry, mostly at Guggenheim Partners.
Great, Matt Hogan. I'm the CIO of Bitwise Asset Management. We manage about $1.5 billion in assets, mostly for financial advisors, all in the crypto space. Like Steve, I come from an ETF background. Before I joined Bitwise, I was the CEO of ETF.com and Inside ETFs, so spent a decade in the ETF industry.
Hi, Ryan Lovar. I've been focused on ETFs for about 15 years, currently the general counsel at Wisdom Tree. We have about $75 billion under management, currently have a Bitcoin and Ethereum ETPs listed in Europe, and focused on that space currently in the US.
Great. So Matt, I think maybe you could kick it off with giving kind of an overview of the historical development of the Bitcoin ETF space in the US.
Of the Bitcoin ETF space in the US. People have been working on a Bitcoin ETF, as you all know, since 2013, when the Winklevoss twins shipped their first S1 for a Bitcoin ETF. Since then, I don't know, a dozen people, some of which are up here on the stage, have filed. Some people have been rejected and plan to file again. But that's been the story. I think important for people in the audience who don't know ETFs is to contextualize two things about the ETF space. First, this is not atypical. Like the history of ETFs, 30-year history, every novel ETF has taken a very long time to launch. Bond ETFs took multiple years, commodity ETFs, multiple years, gold ETFs, multiple years, and $15 million in regulatory fees. So it's not unusual for it to take a long time. It's taking longer than we'd like, but it takes a long time. And then the other thing is that ETFs weren't always considered the mother's milk of investing. I remember when Congress called ETF executives in front of it and asked them if ETFs were destroying American entrepreneurialism. So just because there is skepticism of a new financial asset does not mean that skepticism will persist forever. Today, everyone who invests in America probably owns ETFs. It's a $7 trillion asset class. So it can change rapidly and significantly. I think that's happening for crypto. And just because it's taken a little while doesn't mean that we won't eventually get there.
That's great. Ryan, you had said Wisdom Tree has ETPs traded, and we talk about ETFs and we talk about ETPs, but maybe you can give like a little overview of what's the difference, how does it impact investors, and then also maybe tell us how the process works to get an ETF product approved in the US.
Yeah, so I think many people, think generally considered those that don't, although they many times go by an ETF. So there's not a common vernacular. I think Matt, really hit on a good point though around the process, and that, at Wisdom Tree when we're developing product, we look at, does it fit within the current regulatory framework, and a lot of times that's on the listing side. For many years, there weren't listing standards for even actively managed ETFs until a couple of years ago. And so, any time you don't have a generic standard, you're in really a subjective realm at the SEC in order to make the arguments around this product really does benefit investors. It has an investor protection mandate associated with it, which is certainly what all of us are trying to argue right now for some time. Somebody didn't like what I was saying.
Okay.
But I'll keep talking. So either I'm saying things that are good or bad. I don't know. But no, I mean, so really we think about this not dissimilar from any other ETF, where you go through the process, and like Matt noted, it's taking a little longer than we'd expect. But and we just jumped in not too long ago, I think, just trying to understand really where the maturation of Bitcoin and the trading of it was, and was it ripe really to meet those SEC standards? And we think, and that's why we sort of got in, is because we think now is the time, and that groundwork's being laid.
So, Steve, I know Valkyrie is currently in registration for an ETF. Do you want to talk a little bit about your process as an issuer in the space, and then maybe we could talk a little bit about why ETFs actually provide, we think, enhanced investor protections over the way that retail investors can access crypto right now?
Yeah, absolutely. So maybe backing up a little bit, I spent a lot of time launching very esoteric ETFs in my my former TradFi role at Guggenheim. I was just this dumb bond trader who was managing institutional money and decided, hey, let's launch ETFs. We didn't know anything about it, and let's put some of our esoteric bond strategies in these things, and because they seem more efficient. And a lot of the strategies we came up with took anywhere between 3 to 7 years. Right, and these were just, in our opinion, some plain vanilla, fixed income strategies that were investment grade, but we wanted to actively manage them. That was a 5-year process to get the SEC to approve an actively managed ETF, and the process is you file, you answer lots of questions and comments, and you do it over and over and over again until you finally get them comfortable. And so going into this, I knew that there was going to be a long process, and when the first ETFs were filed by the Winklevoss twins, I didn't think that they were going to get approved. I truly believe that they were all going to be rejected before the timeline hit. This time around, I do feel like it's a little bit different, but we tried to review the comments from the staff. We tried to explain, intelligently as much as we could, what it was that we were doing slightly different and how we would, potentially protect investors within the product, and we try to put those things in the filing, and we spent a lot of time on the 19 as well to address a lot of the concerns. And if you look at the Dahlia Bloss letter, that addresses a lot of the concerns that the SEC had at that time, and those are the concerns that we were trying to address, and a lot of those have naturally been addressed in the market.
What
custody.
would you say the biggest items were back then that they thought needed to be addressed?
Yeah, so custody was probably one of the biggest issues. If you remember back in 2017, 2018, a lot of custody and exchange solutions were being hacked, and money was being stolen, or somebody ran off with the money in the case of Canada. And that was probably one of the biggest things. And a couple of solutions like Gemini and Coinbase have come up with very institutional grade solutions in the last 3 years that have made it a lot easier to hold assets in a secure solution.
So I know that recently the SEC came out with more guidance around the ETF space. They seem to be very focused on the risk of manipulation in the space. What are you seeing around how the industry can do even more to kind of decrease the SEC's risk about manipulation? We have a large number of highly regulated crypto exchanges in the United States, deep pools of liquidity. What are the other things when you talk to the staff, if anybody's willing to share, what are things that make them comfortable about how the market's progressed around manipulation, or maybe things where they think there's still more work to be done?
Yeah. Well, for me, the first thing is, and a lot of people in the Bitcoin community already do this, but in the early days, there was a lot of manipulation in the price of Bitcoin. And as the asset class has grown, and it's, by the way, it's no different than a micro cap publicly traded equity or some other commodity that's really, really small. But as Bitcoin has grown and the user base has grown and the price has grown and the number of wallets has grown, it's a lot harder to manipulate. But there are still bad actors out there that try to do that, and it's detrimental that leaders in this space are very active in trying to shut those types of people down, and they already do.
Yeah, I mean, I would build on that. Part of the reason people are confused about how long it's taking for a Bitcoin ETF is that I believe personally, if you approached it today from a naive perspective and looked at the market, you would evaluate it and determine that it's significantly institutional enough that there are enough investor protections to allow an ETF to occur. But of course, that's not how humans work. A lot of people who aren't in Bitcoin day to day are anchored on the ghosts of Bitcoin past, in this era that Steve was talking about, when market manipulation was more of an issue and more of a concern. And the response to that the wisdom tree that Steve and I are all trying to do, you have to overwhelm them with data. So it's not enough to make a 51% argument. You have to make an 85 or a 90% or a 95% argument. And that's the reason it's taking longer than people who are maybe native to crypto assume. Because again, if you evaluated it today, you would say clearly it's on side. But that's not enough, because the way people work is that they're anchored in when they first came into contact with it. And if they're anchored in this era of manipulation, you have to do more than just an okay job. You have to do an exemplary job. And I think that's what the three of us and others are trying to do.
So one of the things that I think it's worth talking about is the fact that the vast majority of U.S. investors earn their retirement wealth, right, through 401k plans, IRAs, and sort of traditional equity investments, and ETFs are a significant part of that, Matt, as you said earlier. And right now, the only way a U.S. retail investor can invest in that class is either by buying one of the originally privately placed equity vehicles like Bitcoin's products or Grayscale's products that are now traded on OTC markets. They don't go through SEC registration as an IPO, but they are able to be traded there. Or they can buy crypto directly anytime they want, 24 hours a day. So, Representative Warren Davidson, can you talk a little bit about what Congress is seeing in this space? I know you're particularly very focused on the crypto space and on investor protections, but what are you seeing as ways that Congress needs to acknowledge that they might actually be providing investors less protections by blocking a regulated product like a crypto ETF, as opposed to how people are investing now?
Yeah, hey, thanks for the question. And it's a real honor to join the panel. And, Matt, you highlighted, particularly political folks are anchored into the past experience. I mean, because you have a constituency. And, in this space, there has been fraud. There's been, several instances of bad actors. And some of my colleagues are afraid that if they, put some sort of regulatory piece in place, that will make it viewed as some safe place for investors to go. So they're reluctant to move any legislation because there has been fraud. Normally you would say, well, how do you prevent the fraud? You would pass a law to protect the investors. So, that's been, a bipartisan sense. Darren Soto from Orlando and I put together the Token Taxonomy Act. At the end of 2018, we've worked for a while to get that across the finish line, but a number of other pieces of legislation are on hold, mostly because of the anchored feeling there and the uncertainty, in the space. Fear, uncertainty, and doubt dominates a lot. It dominates legislators as well. And the other piece of influence here is this is not the number one issue in any congressional district, right? It really isn't.
How's that possible?
Unfortunately, we would love it to be. But if you think about the investors, this has been probably the best performing asset class over the last decade. So what has happened for whether it's the individual investor or pension funds? They've really missed a big part of portfolio growth if they could have participated in this space. So you talk about getting a 90-95% solution, just showing here's how this asset class has performed, and guess what? It's not in your portfolio. And for a lot of people, they're not going to buy it. They're not going to, open source download the code and air gap a wallet or anything like that. Certainly most of my colleagues in the House are not going to do that. But I'm looking forward to tomorrow talking with Senator Lummis. On the other side, I finally have a dance partner in the Senate that is willing to move something on the Senate side. So hopefully we can get momentum and we can move legislation. And I think, frankly, even recently being elevated to be the ranking member in our committee says good things about the momentum for fintech broadly, but blockchain a little broader than here, Bitcoin for sure, because it's the iconic representation of the space.
Great. Well, one of the things that I think is really interesting is kind of more macro and international implications of things that are happening in the Bitcoin space specifically. For example, we've seen Canada, which has a regulatory structure that's very similar to the SEC, approve, I think now 4 Bitcoin ETFs. U.S. investors are able to access those, those Canadian-listed ETFs through different brokerage accounts. We've seen China crack down on mining in Mongolia, and my understanding was Chair Clayton previously, who's previous chair of the SEC, expressed some concern in the manipulation category around the fact that so much mining is done in China. So what does the panel think about kind of these macro events and how it may also implicate the SEC's consideration of approval here?
Yeah, I mean, I think, the SEC certainly looks at the macro events, but I really think it goes back to sort of those investor protection things we were talking about. WisdomTree, we really focus and really on the ETF as an investor experience and creating portfolios of ETFs. And I think if you not only look at the performance of Bitcoin, but you look at it as a diversifying asset, uncorrelated to the S&P, even less correlated to Bloomberg Barclays index. So, adding it to a broad portfolio, adds not only performance potential, but also diversification benefits. I think what we're also finding is we work with a number of financial advisors, and what those advisors are finding is that their clients, that retail population, are actually going outside of the advisor to access Bitcoin, and not so it doesn't become part of the overall financial plan. Whereas, if there's an ETF that can be part of that, it can then be part of the holistic financial plan that the advisor is implementing as part of the ETF. So, I mean, that takes it back to the U.S., but I think, that's an important focus in terms of, how are retail investors accessing, Bitcoin, and, what are the hallmarks of the ETF that make it beneficial. I think that will ultimately carry the day.
Great. Matt, you have any thoughts?
I think all of the macro events are pointing in one direction, which is the mainstreaming of Bitcoin and other crypto assets as an institutional asset class. And so absolutely, mining power moving out of China and moving more into the US is a positive thing. Again, the test that we're running through the SEC, we're presenting data that makes an argument that the market is mature enough to support a Bitcoin ETF. And there's not a clean yes-no binary answer. It is a shade and a spectrum. So all of these positive events, whether it's China, or whether it's Mass Mutual putting Bitcoin on its balance sheet, or whether it's S&P 500 companies allocating to Bitcoin, or BlackRock talking about it as an institutional asset class, all of that shapes the environment in positive ways. And it's really been a one-way train over the last 3, 4, 5 years. And so I think it's moving us closer to an ETF. I do think it's a matter of when and not if. And I think the when is relatively soon.
Yeah, and I think we're seeing, continued positive developments at the SEC in terms of the entire digital asset space. Both allowing now broker-dealers, at least special purpose broker-dealers, to, custody, Bitcoin, but also more particularly just recently announced that, registered mutual funds can hold Bitcoin futures, which to me was a big deal. There was some risk factor statement in that announcement by the SEC very recently, but I looked at it and it said, the SEC is now looking at Bitcoin futures in particularly, and allowing that registered product, really a hallmark of the investing industry, the mutual fund. I was not happy they didn't allow the ETF the same exposure, but I do think over time, as Matt just said, we'll get there. But I have seen some positive progression that I'm excited about and does keep me optimistic.
Yeah, and from a macro perspective, it's more important to hold Bitcoin now than it ever has been. The U.S. is printing more money than it's ever printed, not just in the last 10 years, but in the last year. Its balance sheet is more than doubled. And other countries, in order to remain competitive from an export perspective, has to also print money. So if all the country's government, or all the world's governments are printing fiat, and there's one standard that has a limited supply, then that is a very important thing in people's portfolios and on companies' balance sheets. And to have investment products that allow you easy access to that is one of the most important things right now. And ETFs provide that. And so right now everybody's going after, you can hold your money on exchange, that's not safe. You can try to figure out how to hold it in your own wallet, which also, things break, things get lost, things, get lost in a boating accident. And, but also in the US, people are just buying, GBTC, which isn't a great product, from the perspective of, compared to an ETF. But also you can backdoor and buy Canadian products into your portfolio. So you're going all the routes around a regulatory product just because we're holding up a regulatory product, a regulated product, and it's more important than ever to have that available to the public and to be able to hold this asset.
Yeah, I think that highlights one of the most important things is if you think about your fiduciary duty, if you're a fiduciary, I think Michael Saylor's made this case very well, is if he's got a lot of cash on his balance sheet, what's the fiduciary responsible thing to do? Well, protect the value of it. And he realized he wasn't going to do that when the Fed's basically just Dogecoining the U.S. Treasury. When you look at that fiduciary duty, you look at normalizing other things. And I think really the thing that's got a lot of people excited is you have Chairman Gensler, someone at the SEC who actually understands the space. I mean, he's got videos for free on MIT where you can say, okay, the guy actually understands it. Now, is this going to be his most important thing at the SEC? Probably not his top priority, but I think it'll be a top tier priority. And so I don't know if by the end of summer they'll have something, but I'm hopeful. And the dialogue's already been pretty good between Congress and the SEC, so it's noticeably different.
So I just had a little evil thought, which was I think Chair Gensler had given some testimony a few weeks back talking about one of the priority focuses of the SEC will be to look at crypto exchanges to see if they need to be regulated as national security exchanges. So there's massive downside there, and I've worked at the SEC, so I can be slightly critical. I have the alumni card, but if that happens, does that take the ability for them to say there's too much manipulation in the asset class off the table? If they then can regulate the exchanges where the asset's traded, is there an upside to what I think is a very considerable downside?
I don't know what the SEC would think. From my perspective, it would solve the problem. The issue I have with that is it'll take a long time.
Yeah.
I don't think that's going to happen tomorrow, and I think the broader ecosystem is mature enough today to support an ETF. So I do think that would be positive. I would actually say that would just be a net positive. In general, the story of crypto over the last 3 years has been every regulatory step forward has been a positive for the industry. If we want this to be a mainstream, institutional, multi-trillion-dollar asset class, we need positive regulation. It's not going to get there with the status quo. So the idea of regulating crypto exchanges like national security exchanges, the details matter, but broadly speaking, that's going to be good for this being a multi-trillion-dollar asset class that sits at the center and is one of the growth engines of the American economy.
Well, that's interesting. Part of the ETF process is not only does the issuer have to file a registration statement with the SEC, but the stock exchange has to file a process called a Form 19b-4, so it's a twofold process. And I know that the exchanges are very eager to get these products traded and to allow retail investor access. And I think one of the points to make around, Steve, like you were saying about GBTC and BITW, is that if you're an accredited investor, you can purchase directly in a private placement. You hold the shares for a period of time, and then you can sell them in the public market. And so secondary retail investors who can't buy in the primary are sometimes paying a significant premium to NAV, and sometimes they're paying a discount to NAV, but it's not like an ETF where they're paying NAV at all times. So there really is a fairly significant upside to the retail investor to be able to buy these kind of equity instruments through their 401ks and IRAs, and to buy directly from the ETF provider. But we have like 20 seconds left. We want to do an over-under pool on how long we think it's going to get a BTC ETF approved. Ryan, you want to go first? You got 8 seconds.
I think Matt, I'll steal Matt's words. I mean, I'm optimistic. I think we'll get there on the timeline. I mean, we're hopeful a 2021 event. But I think to Matt, if the regulation of exchanges, I mean, that might impact the timeline certainly if that's a precursor. But again, remain optimistic and working to get the data there.
Great, Matt.
I think 2021 is a toss-up, and 2022 is close to a not a certainty, but it's highly likely. I think there's a good chance in 2021, but it remains to be seen.
Great.
I agree with these two guys. But don't let a delay in an ETF stop you from buying Bitcoin.
Correct.
Yeah, I'm optimistic that we're going to see some momentum out of the SEC. And frankly, I think you'll see momentum out of the SEC faster than you'll see it out of the House Financial Services Committee.
Well, we appreciate your pushing, which we know you are. So the industry thanks you for all your efforts, and thanks to the panel, and thanks to the audience.
Thank you.
An ETF around the corner, but of course, Bitcoin still for sale on exchanges. How's everybody feeling? Almost lunchtime. I did see that there was a little rain outside. Might be a good time to stay dry, stay inside, keep learning about Bitcoin. We've got a few great panels left before we call it a break. Personally, really excited about this one. Going to be moderated by Mr. Nolan Bowerly, one of my personal teachers on my Bitcoin journey. Of course, we worked together back in the day at CoinDesk. He's going to be talking to you about the product market fit for Bitcoin. Of course, Bitcoin, an invention we're still learning about, still discovering, and the market is still trying to figure out how to get its mind around it. We're going to hear from Nolan, and he's going to be joined by a special guest, so let's hear it for them. Felipe Bacazzi, CEO of XVTO. And then we've got Nolan Bowerly, author of the forthcoming book, The Satoshi Wedding Murders. Nolan, take it away.
No more fist bumping. Fist bumping's done. We're back to handshakes, everyone. So it looks like Bitcoin has already found a bit of product market fit, wouldn't you say? We've got some fit, it's happening. But today we're going to talk about some of the cutting edge product market fit instances around Bitcoin. And luckily we've got Philippe, who has sort of seen this over the years. And I'll start with a little bit of a frame that, in my opinion, we can tell product market fit, not because it's a good idea, not because the math works out or the projections work out, We know we have it when people physically move to do something. Now, it looks like a lot of people physically moved to come here, so this event certainly has product market fit. But in the actual world of the markets, and with how Bitcoin's performing, there's all kinds of instances. And Philippe has seen the data, he's seen people move, he's seen people buy, he's seen people sell. From the very beginning, he's seen all of that. So I want to get started with a question around liquidity. Liquidity didn't really exist in the early days, right? There was not a lot of liquidity. What was the first time you said there's product market fit for liquidity amongst institutions, that these large buyers would come? So what did you see, how did you see it, and how much energy and enthusiasm did it give you?
First of all, hello Miami. I'm glad to be here in person. So much energy. I'm really pumped for the next couple of days. It's going to be amazing. So we at XBTO, I'm the founder and CEO of XBTO. I started in Bitcoin about 10 years ago, but I didn't find a business fit until 2015, early 2015. And our background was institutional hedge fund trading and derivatives. And we had developed a lot of algorithms to basically trade on multiple exchanges bilaterally, but also on exchange. And we wanted to basically use some of our knowledge in crypto. And so in February 2015, it was still very much the early days. I didn't believe that it was necessarily going to go up as fast as it did. It was difficult in the beginning to figure out who were the natural buyers, who were the natural sellers. Obviously, miners are usually natural sellers. But when we started out, things were kind of broken, right? Exchanges worked, but not really very well. Liquidity was really sparse. And we were like, how do we make a market without getting run over, right? And so it was a small ecosystem, and still is a small ecosystem. Most people, obviously there's a lot more people, but most of the core still knows each other, and the players have changed. But that core is still very much in contact and keeps that ecosystem going. So when I started making a market on one exchange in New York, and then by the end of 2015, we were on 5 or 6 exchanges globally. It was a global thing. There were onshore exchanges that were just starting, trying to figure out how to get regulated. And then there were the offshore exchanges just gunning for it. And the way we found people to trade with was through, first of all, exchanges, right? You would talk to an exchange, they would say, hey, you need to talk to these guys, right? They're pretty big, they're starting. No big player known, right, were there at that time. I mean, it was still ultra high net worth, family offices, large traders that had sort of like gotten, went down the sort of Bitcoin rabbit hole and became really interested in it and so passionate about it. And so, some of these startups, we were introduced to one another. We're like, how can we make a better market? Which exchange are you trading on? What can we do bilaterally? Which products make sense, right? So we were very early in the spot trading. We were very early in relative value basis trading in futures, in exchanges that were mostly in Asia, of course, because the CME and the CBOE and ICE and all these sort of regulated onshore exchanges came later, right? In later 2017, and we were already doing that in 2015, and the market was absolutely crazy. The sort of volatility, not only a volatility from the market, but the technology kind of would break at the worst possible time, and you'd have to move collateral, and you didn't really know if you were liquidated, and sometimes the exchange would break. You didn't know if you were like, your hedges had gun taxes on you. You didn't know. You were like, okay, well, I'm long a future here, I'm short the spot here, And I don't really know what my position is because this exchange, we don't know if it got hacked. There was so much FUD. There's still a lot of FUD, but it's a lot. It's gradually gotten a whole lot better. There's much bigger players now, and there's going to be a whole lot more bigger players.
So in that relationship, you had counterparties basically lining up, and then they're trying to solve problems together in a sense because the venues to solve those problems, or at least to get to the outcomes that they wanted, didn't exist. So what were the kind of places that people will go at that time to solve these problems? Was it, just the ones that were able to complete the trade and make the market? That was good enough at the time?
Yeah, I mean, at the time, it was you worked with what you had, right? There was no path to success in providing liquidity. Some things made sense, some other things did not make sense. What was simpler back then in 2014, 2015, is that the universe of coins was much smaller, so at least you didn't have as much noise. And I'm saying that it's all noise, there's a lot of signal. But it was mostly Bitcoin and Ethereum just started up, and then there was the whole Ethereum Classic, and there was a whole lot of forks. But yeah, we would meet in 2014 at like Bitcoin, and Bitcoin 2014, I think it was inside Bitcoin in New York, and it was a Javits Center, but it was like a small room with about like 50 or 60 people. It was incredible. And you'd meet everyone, and you know everyone, and you'd be, what are you working on? What can we do to make this space better, right? So that the next generation can actually buy Bitcoin without having to slip through an order book 10% and be like, or make scams a little less prevalent.
Let's go into that and talk about product market fit there, because you said you were making markets just in spot, right? And that had its own limitations. When did you know that the derivatives market was going to have such an uptake to the point where it's grown that volumes are, of course, larger than spot at certain points? When did you start seeing the product market fit for these new derivatives contracts that came out? And what was luring more of these counterparties to come to see these sophisticated, bespoke contracts and markets that were being made?
Well, you know what? Actually, we did not know, and XBT has always tried to be first. We were first on CME block trades, on ICE block trades.
Yeah, you did the first ever trade on the CME futures contract. I remember that.
We had no idea if that was going to stick. We were the first on options. We were an early investor in Deribit.
Yeah.
So, and in the beginning, there was not a whole lot going on. We basically were 90% of the flow. But what the important thing is that we came from the traditional world, and we knew the importance of derivatives in a market, right? Spot's important, but I'm so happy that we have options today because I can actually hedge my risk a little bit more precisely now, right? Back in 2017, there was no deep option market. You couldn't really do it bilaterally because you couldn't figure out the margining, you couldn't figure out the clearing, you didn't really know if the counterparty was really solid. So it was much more difficult. Now, you've got real players that are providing real stability, real clarity, and you can actually, if you have a doubt, you can go and say, I'm not really sure this market's going to keep going up. I'm going to buy some puts here. I can protect my portfolio a little bit. We didn't have that back in 2017. So this is providing stability. It's providing more liquidity because then it provides other reasons to trade the space, right? So derivatives actually provide more liquidity, both in Bitcoin and in all of the other tokens. Obviously, in the other tokens, there's less of a market, less futures, and even less options.
So we see this sort of, let's call it canvas size, or the ability to express your strategy has become much more fulsome. There's way more ways to express your strategy with precision. Where is that headed? What do we need in order to have even more canvas size and expression for strategies on these platforms? What's missing?
Oh, things like credit default swaps. If you're really going to push it, at some point it's going to come. I think insurance, generally, CDS and insurance kind of goes together, right? All of this is going to further stabilize the space, provide more confidence for the pension funds and the banks, and they're coming. But they need all of these things to be comfortable, right? They want to be able to work with players that can demonstrate that they have a certain amount of insurance on their AUM, on their assets. Because, in Bitcoin, not your keys, not your Bitcoin, right? And so the minute you start trusting someone with your Bitcoin custody, I mean, if something happens, you're really, there's nothing you can do. Really, there's nothing you can do. So insurance is important. Now, we'll have to see how insurance provides enough coverage, because Bitcoin is so volatile and it is on such an upward momentum. How does this go together? And so I think there's going to be Bitcoin-based insurance products that kind of have to go up in.
So more products coming that are a function of the volatility and the ability to maneuver that type of volatility.
Yep.
Correct? So, but it isn't all just about the products that can come from volatility, of course, right? There are products that are designed to work alongside Bitcoin, like stable coins, that help us deal with the volatility a little better, even on the consumer side. So where do you see stable coins really finding product market fit in Bitcoin beyond just the simple long Bitcoin trade that you can use stable coins to move in and out of?
Yeah, so stable coins provide an interesting utility. But back then in 2017, the beginning of 2017 and 2018, it was only about $1.5 billion worth of stable coins, right? Today we're at over 100 billion, right, of stable coins. Not only Tether, but USDC and Paxos and a lot of different sponsors. Other currencies are coming and becoming available. A little bit slower adoption there. But stable coins provide that during 2018, that sort of refuge, right? That way of saying, I've got to pull out a little bit from the crypto native tokens that are extremely volatile and right now going through a phase, but still stay in the crypto world, because the utility of a stable coin is it's first of all, it's kind of a bearer asset, right? You can move it very easily, everywhere, anywhere, fairly cheaply, and efficiently and immediately, right? And so that's really important when you're trading, first of all. Now you've got you can earn yield on these stable coins, because $1 in a stable coin is worth more than $1 in a bank account, because it's more movable. You can move it faster, you can do more with it. There's more flexibility to it, right? So now you have products that have done extremely well in the last 18 months, right? In terms of earning yield on stable coin, but also on Bitcoin. And that's really important. Now, payment is sort of the third thing that has been done. Of course, there have been payment companies. The problem is, blockchain has had trouble scaling, and you don't want to pay $3 for a transaction when you're buying a coffee. It does not make sense. You don't want to wait 10, 20 minutes. You don't even know when the finality of a transaction is going to be. That does not work. But for me, trade, earn, and pay is that third utility that's going to come, that's going to be very, very powerful. But it's still sort of being figured out. And you're seeing it. A lot of the big players are rolling out their payment capabilities, their debit cards. The debit card is just a bridge to get you there. But eventually, the idea is, why pay 3 or 4%, sometimes 5% in places like Bermuda, where things are pretty insular. You don't really have a lot of payment options. And they're very expensive. It's almost like confiscatory.
Yeah, I'm glad you brought up Bermuda, just because I think of these countries, and you can see a bit of that product market fit with the way countries are adopting, or at least being open to these currencies. And Bermuda has been one of those great examples of having its mind open to this. And you see a flood of people physically moving there. Of course, the famous Bermuda Shorts picture of CZ years ago. What do you see with these countries and their ability to help Bitcoin find product market fit by being so open-minded?
Bitcoin is sovereignty. When you are a smaller country and you're trying to protect your sovereignty, you're trying to protect how to stay relevant in a world that's changing rapidly. Decentralization is very powerful, right? So I think we were very early in Bermuda, and we helped shape the regulation over there. And we made a commitment to move to Bermuda to actually build Bermuda to be ready for the sort of next century, because we really believe that things are definitely going to change from a very sort of centralized approach, government and currencies, to something that's much more democratic, earned by the people. And I think these smaller countries, these offshore jurisdictions, are perfect places to do this, because you can really have an impact. As an individual or as a company, you can really have an impact on these emerging jurisdictions, right? Because you can talk to the regulator, you can talk to governments, you can
their sovereignty
educate
is,
them a little.
Yeah, it's more similar to the sovereign individual.
Here, where it's multi-agencies, they don't really talk to each other. You're trying to figure out where you're regulated. FinCEN and SEC and CFTC and this and that, and state, New York, DFS. It's complicated. New York's complicated. U.S. is complicated. So Bermuda is Cayman and some of these emerging jurisdictions are really interesting in that, in this new world.
You were mentioning about you've got, let's call it, you said the trade, earn, and pay, right? You can think of the uses of money as, savings, which is sort of like earning in a sense,
right.
Trading, investing in a bit of a category, using, there's all kinds of uses for it. The other one I would see is, let's call it sharing, which is lending, borrowing, in a certain sense, crowdfunding, right? That almost fills the complete circle of a financial life around a person who needs to use these tools. What do you see in that other category of sharing, right? The ability to invest in crowdfunding platforms or in these different collateralized lending tools and the P2P lending and borrowing. Is that an area you see a lot of growth potential for product market fit in the short term?
Well, 100%. I mean, disintermediation is very important. It's actually the whole point. And we've seen it through ICOs, seen it now through sort of next cycle with DeFi. You feel like you really own your money, right? When before you had it in the bank and you really couldn't do a whole lot with it, you had to rely on financial advisors. You couldn't really get access to the next big thing because there were gatekeepers. Now you feel like if there is a project out there that makes sense and you're fast enough, you can go direct, right? The crowdsourcing is really powerful. We had crowdsourcing before, of course, but now we're really taking it to the next level, right? So I think whether it's in Bitcoin or a stable coin based on a dollar or a euro, it's all sort of the same thing at the end of the day. Some makes more sense with stable coins, other with Bitcoin. But yeah, I mean, sharing economy is definitely something that is sort of the undercurrent, right? It's basically what is going to bring us to the next, to the next level of serving the underbanked, serving the unbanked, and potentially unbanking the banked, right?
Yeah, I never heard it put that way. Unbanking the bank's a good way. Yeah.
I think that personally, I barely have any dollar in a bank account. I really don't. It's mostly I'm really all in this space. So we've been for a long time.
Well, and that's kind of showed, I think people, what you mentioned before with the bank, you gave them your liquidity in the past. Maybe an advisor would help you, their best, I suppose. But really they were trying to get you to be a long-term subscriber to some loan or mortgage. So the ability to express yourself with your savings was limited to the products that they were offering you, which were good for them, because that was their own ability to take short-term deposits and offer long-term loans. They were performing the maturity transformation themselves. Would you say that with Bitcoin, we found a way, when people say be your own bank, it's more like, why don't you adopt the bank's business model for yourself, where you can actually put money in places in the short term and take money out in the long term? Is that a frame that you would use to try to determine product market fit? Are you saying when people are being their own bank, it's not be your own safety deposit box. It's use all the terms that a bank uses to express itself and make money, but now you can do it. You don't need all these other pieces that the bank fit in. Is that a frame you might use, or do you think that way when you're thinking about the customer, the counterparty, the client?
Well, I think the sort of structure, the whole infrastructure, the framework is changing, right? The word bank is sort of a legal term, in a lot of ways. You want to be able, in the future, you probably want to be able, and I'm not saying you should self-custody, because self-custody brings a whole lot of risk that most people, I'm going to say 99%, should not probably take. As the risk of loss is real on these bearer assets. But I will say that with the right counterparty and, sort of the whole 20-80, where you have 80% in cold storage, whether it's with a counterparty or not, and 20% that you use to do things, payments, and potentially, trading, that makes sense, right? So you are your own sovereign financial advisor, bank, whatever you want to call it. That's the whole liberation. That's the whole freedom that this space brings you, and you should embrace it. I think everyone should embrace it.
Yeah, because it's not really about, like I said, self-custody is not synonymous with being your own bank. It doesn't mean you just hold it, right? It means that you're able to find ways to make money and increase your net worth.
Yeah.
So along those lines, you guys do also focus on some of these venture plays and let's say seeding some of these companies in the space. Is there something that you're looking at there that is particularly strong, where you think product market fit is going to be found that really helps an individual increase their wealth? Is there some project that you see right now that people are going to flood in when this thing is offered to the public?
Obviously I'm biased in many ways because we look at the world in a certain way, and obviously we've been progressing naturally. I think blockchain is evolving. Ethereum is going through a major change, potentially a major change in July. We'll see how that scales. There are other blockchains that are sort of better suited to do certain things. Again, I think we go back to the trade, earn, and pay model. I think one of the companies that I'm sort of pushing right now is a company called Stable House, which is based in Bermuda, and it's leveraging Bermuda's sort of regulatory framework. And we want to be a place where people can, trade if they want to trade a certain asset, earn on that particular asset, and use it to pay, right? Because you want to have the ability to use those crypto assets most efficiently, right? It's not only meant to go YOLO and on an exchange 100x, right? That sort of was like what we needed this to build the liquidity, to build the value, to know what the value of a coin sort of is at any point in time. There's enormous amount of liquidity and volume, and that's really important. And that basically supports sort of the security behind Bitcoin and Ethereum, because there's mining, proof of work, maybe sometimes future proof of stake, but the liquidity is very important because network effects relies on enormous amounts of liquidity and a good amount of hashing power, right? Put two together, and then now you really have the ability to understand what your stablecoin is worth, should be worth one, but the market is telling you what it's worth, and it's very, very deep. And Bitcoin is the same way, right? So I think Stable Houses, when we get to pay, and right now the trade is sort of in beta. Earn is launching in about a month, and payments is definitely coming, and we're going to make sure that we're going to be leveraging DeFi in the back end as compliantly as we can, because DeFi obviously is still relatively new. It's difficult to understand for the layperson. It's rife with risk, smart contract risk all the time, but it's going to grow up. So much like everything. It's going to grow up, and it's going to change everything. And we want to have Stable House that help in sort of being that guide.
So
be the guide. Educate.
We look forward to people physically moving and buying all kinds of stuff with stable coins, consuming, investing, and the world is their oyster.
100%.
Great.
So excited.
We're getting kicked off stage, everyone. No more product market fit talk. Thanks for your time.
Thank
and
you so
please,
much.
everyone, thanks for Philippe. Good stuff.
You know, it's a good panel when there's more to talk about. And of course, more to talk about in our forthcoming panels. Only a couple more. People feeling it. Hope your energy levels are doing good. Feeling excited. This is only day one. We've got a couple more days to go. So hope you guys are feeling it. I know it's been tough. Been inside. I myself have been in the same room a lot. Nice to be on stage. We're talking about one of my favorite topics coming up, which is hodling Bitcoin. That's HODL. HODL. How many people know where the term comes from, hodl? Anybody who knows the story, a famous Reddit post, I am hodling. Why? Because I'm a bad trader. It's hard. People make it seem easy to hodl Bitcoin. It's not, right? It wasn't too long ago where you go out to dinner and half your Bitcoin position is gone. So stay strong, hodl, and remember, not your keys, not your coins. So next panel is going to talk about this. They're going to tell you how to hodl safely. All right, we've got them coming up here. First up, Mr. Will Cole, Chief Product Officer at Unchained Capital. Our next hodling expert, Alex Dashkolov, CEO at Knox. And finally, another hodler, David Abner, Global Head at Gemini, Business Development at Gemini. Hodling.
Hey guys, thanks for coming.
Howdy.
I noticed you both didn't go for the business attire dress code they requested today. Well done. Well done.
This is the Texas business.
Yeah,
attire.
that doesn't. It didn't really fit the. I noticed business on the agenda, and I was thinking that didn't really fit the mandate. But I'm glad you're here. I'm glad you both made it. Why don't we? I'm going to start. I'm going to introduce myself just briefly. You know, they have our names, but I am the head of business development at Gemini. I've been at Gemini for only 6 months, actually. I came out of WisdomTree. I spent 11 years at WisdomTree and 20 years on the ETF side. About 3 years ago, I launched, or my team was responsible for launching one of the first Bitcoin ETFs in Sweden. So I actually could have been on the panel 2 panels ago. And but in my new world, I care more about actually hodling safely, and that's what we're going to talk about today. So, Will, why don't you introduce yourself and tell us a little bit about Unchained?
Sure. I'm Will Cole. I'm the Chief Product Officer at Unchained Capital, where we do Bitcoin native financial services, which basically means that we have a relationship with our clients to help them custody in a self-sovereign way. We do Bitcoin-backed lending, where we do not rehypothecate collateral, and we also do buying of Bitcoin directly into cold storage with keys that you or your business control.
Great, thank you very much. And Alex, you want to tell us a little bit about Knox?
Yeah, so Alex, CEO at Knox. So Knox, really, our medium-term focus is on solving what we'll call broadly the insurance problem in the space. There's something like $100 billion of Bitcoin held in centralized custody. Generously speaking, maybe 1% of that is insured. And as an industry, we really need to get to the ability, in my belief, to insure very large sums of Bitcoin held in centralized custody. I know you guys face this problem at Gemini. And our first product really was a custodian that could call itself 100% sort of one-to-one insured. That's something we run in Canada and looking to expand into a lot of jurisdictions the world over.
That's great. Yeah, we do. It is an interesting topic because there's a lot of Bitcoin centrally held. There's very little insurance in the industry, and we want to hear some more details about that. But why don't we start from the very top, right? And we're here to educate people today, so we want to talk about hodling and its difficulty compared to, or custody really, and the difficulty of storing Bitcoin as compared to traditional asset classes, right? Like cash or gold? There's been a lot of conversation today about the evolution of gold. Bitcoin looks a lot like gold, or it looks like a new form of asset. Why is it either more difficult or less difficult, do you think, than these traditional asset classes to protect it?
Well, I think it's much less difficult. Traditional asset classes, I think, on the problem of custody, trend towards centralization. I really think of it in terms of, how do you custody a physical thing? You have security, and then you have coercion, right? And how much are you going to spend to secure an asset versus how much does it cost to attack and infiltrate that security system? That trends towards centralization, where you get vaults and giant companies that can spend millions of dollars to help you secure something, but you also give up sovereignty over that asset in the process of doing so. And that's one side of it. The Bitcoin side of it, and one of the things I think is such an interesting part of custodying Bitcoin, is that you can do the same thing. You can get the same security posture for free. And you can do that yourself. You don't have to rely on a counterparty to hodl your Bitcoin safely. You can do this directly from what's available on the protocol for Bitcoin, which is through something like multisig, where you can eliminate single points of failure, and you can do it for a couple $100 and have the exact same security posture that a giant corporation, a Coinbase or something like that would have. You can do it personally for yourself or for your business, again, for a couple $100.
Wow. So I want to talk to you more about that and like what sizes you would be comfortable with, but let's come back to that in 1 second. Alex, what do you think about storing and maybe even insuring these assets? Why is it more difficult to insure something like a Bitcoin?
Yeah, certainly coming off from Will's points, I do believe, I can't speak to how difficult it is to hold gold or other physical assets, but I think
well, we used to watch like movies, right? There used to be movies about bank robberies and gold heists, right? All of that stuff is now and I think people are translating that into Bitcoin.
Yeah, for sure. And I think the ability, though, to remove the single point of failure is really critical. I still do believe, for most people, that they should be holding their own coins. In many institutional and other cases, that's, of course, impossible. And that gets us into, call it the insurance point. I believe that a well-set-up custodian like Knox, say running Knox infrastructure, is objectively extremely safe. There is a very low likelihood, but it is non-zero, that a theft or a loss can occur. And it's really for that reason that I believe that insurance should be brought to bear. It just needs to be made more accessible in the sense that we need much higher capacities and lower premiums. But I think you and I would agree that this is maybe a 1, 2, 3 basis point risk at most, precisely because there are no single points of failure.
So it's interesting. Do you think like this is so in traditional finance, and no offense to anybody who may be in the audience, in traditional finance, people thinking about custody is like an afterthought, right? So you don't sit down as an institution that's going to run a long-short equity fund and think deeply about the custody problem. But I feel like the largest custodians in the traditional space are looking at this space and salivating and saying, you're right, there's $1 trillion being stored either centrally, about 1 to 200 billion, or a tremendous amount being not centrally stored that they think they can centralize. Is that going to be a good thing? Do you think the industry is going to move towards that or away from that over time?
I mean, I think the reason that they don't talk about it in traditional finance as much is that they have hundreds of years of history where they figured a lot of these problems out. They understand deeply counterparty risk and how that works, and there's a lot of laws and regulations built up around controlling who can be a counterparty, what type of regulatory regime is defining what a custodian is. I think that with Bitcoin specifically, and institutions, I believe, will follow a very similar path that individuals have, where they start to understand the unique value that Bitcoin gives you with holding keys. We say this all the time, not your keys, not your Bitcoin. As individuals, I think a lot of us practice that. I think institutions oftentimes will think that it's not really possible for them to do that because of the history they've had in traditional assets. the thing that I think ends up happening there is that they follow a very similar path because Bitcoin is just different. It has a different protocol that allows you to do different things, and it all starts with ownership over private keys. If you do not own the private key, you do not get the full benefits of what Bitcoin's offering you. And again, individuals have figured that out, and I believe institutions will follow.
I mean, at what level, right? So we are obviously Gemini is different, right? We hold keys for our customers. And this is a big argument that's been in the industry for longer than I've been in the industry. It's been going on for years, right? And it may be philosophical as opposed to actually practical, right? There's a room full of institutions here, and I get the feeling many of them are scratching their heads going, we would have to sort of change our entire business in order to control that set of keys ourselves. And is that practical for our business, right? So what about the practicalities of that? Why should someone, in your mind, pursue that? What are these benefits that you think exist? And at what size, right? Are we talking about a $10 million high net worth account, or are we talking about $1 billion fund? And would you feel differently about the two of them?
Sure. I mean, to talk about the why, I think you have to talk about what the risks are. Like, what are you actually trying to protect yourself against? And I feel like there are several factors to it, right? There's jurisdictional risks, right? So if you're an individual or an institution, what are the odds or what are the attack vectors in which the regulatory regime that you live under or you operate under is going to be able to get in the way of you doing the transactions you need to do to operate as a business or be an individual, right? So that's one risk. And if you're an institution and you're using a custodian in some sovereign nation or state in the United States, there are ways that those institutions can be pressured based off the regulatory regimes that regulate them to not allow you to do the transactions that you want to do. If you're self-sovereign over those funds, then of course you can transact, right? Bitcoin allows you to be sovereign and to transact free and clear, regardless of the jurisdiction that you're under, if you own the keys yourself, right? There are jurisdictions, countries and states in the United States, like Wyoming, Texas is working on it as well, that are basically trying to sell sovereignty, right? They're trying to sell you on the ability to hold your keys, to do the transactions you need to do as an individual or an institution, and companies and individuals are now shopping around these jurisdictions to find the places that do it. So that's just one, though. That's just the jurisdictional risk. You have physical key risk of where you put the key. You have counterparty risk of who actually has the key, whether that's yourself, people in your company, or if you've given up ownership of the keys, what are they going to do with it, right?
Yeah. Look, I think it's a very interesting topic. I think obviously philosophical differences in the business, but the industry is growing so much, right? I don't think of us as competitors, but we're all going to grow, and there are going to be lots of different ways to offer these services. So I think it's valuable. It's important for people to understand that aspect of it. Thank you. Alex, maybe we'll pivot for a little bit. You pivoted Knox really from custody to insurance at some point, right?
Yeah, I mean, I wouldn't call it a pivot exactly. So really our first product was a custody product. That is something that we offer to this day. And the reason for that was to originate the very risk that we wanted to kind of look into insuring. So when we first started, we looked at the insurance policies that existed and said, basically none of these are good enough. Either they're too expensive, or to the extent that you can get somewhat affordable ones, they do not cover all of the risks that we think ought to be covered. So that was really step one. And we said, we dream of an insurance policy that can cover against loss, theft from the outside, and theft by internal collusion. And then the really important bit here is that if you're going to cover theft by internal collusion, that it be covered across the entire private key lifecycle. So that, I think, was one of the most shocking things when we looked into the policies, and we said, there's no way you can call yourself insured for collusion if you're not insured for collusion at every step of the private key lifecycle. That was kind of the state of affairs at the time. We found the first insurance policy that met all of those properties, and then started kind of scaling that in order to be able to allow other custodians, other FIs, and in fact even other corporations, the same ability to have that extreme security with the ability to be insured. And perhaps to Will's point, it'll be interesting to see what happens down the line in terms of who is going to be holding keys. If you are, say, some institution that is not a custodian, will you reach out to a custodian like Gemini's, or will you perhaps set yourself up with the ability to actually maintain internal private keys? And so that will be perhaps an interesting point. And I think that is one of the methods by which we may be able to scale insurance into kind of the levels that we need, is to say, effectively balkanize it, make it so that keys are stored by all of these different entities, and they can each run their kind of local infrastructure.
I would imagine there'll be some sort of framework for how keys are stored, and whether it's either via centralized institution or an individual or an independent. And as long as they meet all those criteria, the insurance companies should get comfortable with that, right? Is that the way that would work?
Yeah, so I mean, I think the insurance companies are getting more and more comfortable with understanding how these systems work. In our case, for example, we can set somebody up with the very same infrastructure that we've deployed, and then ensuring that is very straightforward, because if the insurance markets look at it and say, we know this risk, we already are exposed to it multiple times over potentially, and we'd gladly write a new policy in order to take on more of this risk originated by some other set of people.
Got it. So a lot of people ask us in our meetings, right? We meet with institutions, and in the top 10 list of questions is tell us about your insurance, right? And we say the same thing, which sounds comical, right? Yeah, we've more than $30 billion worth of Bitcoin or worth of cryptocurrencies under custody, and we have $290 million worth of insurance across our platform. It seems minuscule, right? Do you think that, and we have reasons why that doesn't matter, but I guess from your perspective, or do you think the insurance companies miss the boat? Like we would say, well, we have MPC, we have gating on asset accounts, and we have a variety of different methods to protect assets because we couldn't get insurance for the last 10 years. Do you think the insurance industry has missed the boat and is now coming around? And do you think that this sort of goal of bringing more insurance, is that really going to be important over time, or are we just doing a better job at?
So I certainly think it should, to your earlier point, I've had this argument many times, and I hear people say, well, the systems are extremely safe, right? The likelihood of a theft or loss is basically zero. And when somebody tells me that, I agree, it is true. But if that is true, if it is objectively the case that the risk is near zero, that means that there is an insurance product that could in theory exist, so long as we can actually price the risk. And so that's really the central theme here is, it is possible to do this. The insurance industry, I'm not sure that the insurance industry itself will sort of get around to this, but that's why it's on companies like Knox to actually solve this problem. There are methods by which this can be enabled, and I think we will eventually get there. Perhaps a historical note on insurance is Bitcoin appeared 2009. A few years later, most insurance carriers still did not even know it existed, and companies like Gemini and Coinbase started knocking on their doors in around 2014-15 saying, hey, could you perhaps sell me insurance for this product? Fast forward just 5 years, and now we're in this situation where $100 billion plus is held in centralized custody, and they are nowhere near supplying the capacity necessary. So it's kind of an interesting thing to see is, for the insurance industry, this is the first time that something went from zero to this size in so little time. And I think this is something that you're going to see replay again and again this century with brand new risk categories. They'll go from not existing to suddenly everyone's foaming at the mouth trying to buy more of this coverage.
Got it. Will, do you think from a controlling your own keys perspective, insurance is more or less important in that sense? Like what?
More or less important?
Yeah, what's your view on that piece of
I mean, the idea of insuring keys and whatever your setup is, right? So it could be that, you could be self-sovereign over your funds, but you could be collaborating with other institutions. And, while that institution might not be able to, unilaterally spend the funds or, or lead to loss directly by authoring a transaction, they could end up collaborating with you or with other people in the quorum towards a transaction that you didn't mean to do or wasn't authorized. So I do think insurance can play a role in a self-sovereign setup just as it does in a fully custodial setup. Yeah.
Got it.
Around the use of keys.
Sorry?
Around the use of keys.
Got it. So I guess on this, Matt Hogan in the last panel said that really the disruptions in the industry are becoming less and less frequent, right? We read less about industry hacks, and I mean, sometimes you'll read about them, but most of the time, or almost all of the time now, they are not on the regulated exchanges, not with the centralized custodians, and things like that. Do you think that, and really institutions have never been impacted by them, right? The biggest hacks happened years ago. It was not a big institutional market. Institutions, Novogratz said this morning, it's really a 6 months to a year phenomenon that institutions are coming into this market, and they hear from obviously players like Gemini that say, yeah, we have very little insurance, but you don't really need it because of, and here's why. And they see the news that there's very little happening in terms of negative publicity around the industry right now. Do you think there's a false sense of security by newer institutional players about the industry and the security in this business? I'll toss it up. You guys can both go.
I think to a certain extent, yes. Right. I mean, it depends on what you're talking about. Like in terms of, there's a lot of financial products out there right now where I don't think people understand the counterparty risk that they're taking. Right. When you earn interest on your Bitcoin somewhere, right? Where is that Bitcoin? Who has the keys? What are the scenarios in which those people can lose the Bitcoin? Because once it's gone, it's gone. And so do you understand your counterparty risk?
Once it's gone is true, but there is this concept of your lender or your borrower, having a business behind it that they may have lost the keys, but they still may make you whole, right? And I think that's part of what people are resting on.
Sure, yeah, if the company's still around. In the traditional financial markets, what we know of is that the banks that exist in the fiat world, there are bailouts, there are bail-ins. Right. There's someone coming to the rescue. In the Bitcoin world, there's no printing new Bitcoin. When it's gone, it's actually gone. And are you taking that into account to get your 2 or 3% interest on whatever you're doing to lend out your Bitcoin? I think that there is a miscalculation of risk there. I think that that comes back to who has the keys, actually has the Bitcoin. Do you understand who has the keys to your Bitcoin, contractually your Bitcoin, and what they're doing with it?
Alex, what do you think?
Yeah, so certainly, I don't want to see a large-scale loss. It's great that we have not seen, at least amongst the institutional crowd, to your point, a lot of, renegade exchanges and such are now where you're seeing losses, but we haven't seen, say, a large loss in the institutional space. I do fear one is coming. The way these systems work is you have low frequency, high severity loss events. I really don't want to see it happen, but I think that, I would be surprised if in 10 or 20 years we can sit here and say, yeah, there was never a multi-billion-dollar loss amongst one of these institutional custodians.
Look, it's really interesting. Yeah.
I'll back it up with a concrete example. Like I mentioned at the beginning that we do Bitcoin-backed loans at Unchained Capital, but we don't rehypothecate the collateral. The reason we do it is the reason you're taking out a loan against your Bitcoin is because you presumably don't want to sell it, right? And when you don't rehypothecate, then we store the funds in a multi-sig address. It's boring, it's simple, and maybe you pay a little bit of a higher interest rate on the actual loan itself, but it's not being sold out, lent out to other market makers and traders and on an unsecured basis where a potential for loss is huge there. It's almost guaranteed given enough time.
Huh. Well, guys, look, we're encroaching on the next panel. We could talk for another hour. I have a lot more questions for you. Maybe we'll get another chance in the future. Thank you very much. I appreciate it.
Thanks.
Thanks.
How's everybody doing? I know what you're thinking. Man, these people talk about Bitcoin a lot. Well, good news for you guys who have enjoyed it. We've got a lot more coming up, including another great panel here. And yes, for those who want to continue reading about Bitcoin, also give a plug to Bitcoin Magazine, hosts of the conference. If you haven't gone to bitcoinmagazine.com, check it out. bitcoinmagazine.com/start, also a great way to refer people if you want to check it out. If there's anybody new in your life asking questions about Bitcoin, texting you incessantly, would definitely recommend it. And of course, every journey starts like that. This panel is going to talk a little bit about the continuation, how to become a Bitcoin whale. So I'm going to introduce the panel here, and they're going to tell you how to do that. I wish they'll tell me. I'll be listening as well. First up, Durar Islam, COO of Genesis Global Trading. Next, we have Ian Epstein, president at Oscar Grouse. Alex Machinsky, CEO of Celsius. And finally, Kevin Litiniti, Chief Strategy Officer at Prime Trust and Chief Product Officer at Bank. We'll let you guys take it away, how to become a Bitcoin whale.
All right. Hey guys, we've got like half an hour to talk about how to become a Bitcoin whale, and I think we're going to get into some trading, some custody, some yield, lending, things like that. But maybe we should kick it off with what even is a Bitcoin whale, right? There's not really an official standard for when you magically get a box in the mail and it says, congratulations, you're a Bitcoin whale. So how do you guys see it? Maybe we'll start with Alex.
Well, the good news is that it's a self-determined level. So you can call yourself a whale, or anyone can call themselves a whale. You know, like I think now that Bitcoin is at 40, 50,000, obviously the bar has gone up. But if you hold several hundred Bitcoin, you're in good shape. You're a whale.
Nice. You guys?
Yeah, I think it's, if you're looking at this space as a significant source of your savings, whether at the corporate or personal level, if you're looking at this space as a place that's going to create multi-generational opportunity to get a jump on the future, if you're looking at this space as a place to sort of be involved in the restructuring of the financial services industry, and it's a significant allocation of your human and financial capital, you know, then I would consider you a Bitcoin whale.
Cool.
That's great. Yeah, I mean, from my perspective, working for Genesis Trading, definitely being a whale is twofold. Number one, understanding the aspects and the dynamics of the asset class, because you could be a whale one day and the shark the next day. Market moves a lot. Second, I think holding 1,000 Bitcoin plus these days and executing 100 plus tickets, that is, I think, considered a large trade, a good size whale these days. But definitely this concept changes every month, every day, and if you ask me tomorrow, I'm going to have a different answer.
Nice. You brought up trading, which is a great place to start, right? If you're going to become a Bitcoin whale, the first thing you have to do is acquire some Bitcoin. The way you guys see it, is there really a difference between kind of institutional purchasing and high net worth purchasing? Is it worth going down both rabbit holes, maybe starting with, if you have an institution, I'm sure we have people who manage, you know, large amounts of capital sitting in the audience, maybe from the traditional markets or things like that. Kind of what's the best place if you're that fund manager or something like that to get into this new asset class? Maybe to you.
Yeah, so, you know, Oscar Grouse, we sit in an interesting place. Oscar Grouse is a traditional broker, and our sister company, Enigma, the booth is out there, please come say hi, is started quite crypto native with a number of crypto native clients. We're seeing now in the last 6 months a number of traditional multi-billion-dollar asset managers and hedge funds try to figure out how to get into the space. And what they're finding is that the solutions that were developed for retail involvement are insufficient and incomplete in many instances for institutional involvement, whether that's on the KYC or AML level, whether that's from a risk management perspective, whether that's from a pre-funding versus post-trade settlement perspective. We are very much involved with, as are these gentlemen here, in trying to design a more institutionally satisfactory infrastructure. I would say one of the things that I think institutions differ from individuals with, from an investment perspective, is institutions will welcome central bank digital currencies. institutions will want to see central banks either design their own or acted with repo-like facilities as backstops for stable type coins. And so I think that the priorities and the infrastructure needs to be different for institutions. I think we're developing that infrastructure, and I think institutions, and I would suggest this to the individual investors in the audience, should welcome more government involvement, more central bank involvement. It will result in bigger, more important institutional wallets in the space, and I think that's good for everybody to maintain everyone's whale type status.
You guys do a lot of this trading business as well. Do you see it differently?
Absolutely. I mean, Genesis is a broker-dealer in the space since 2013 in New York, and definitely we have been servicing institutions from day one. I resonate with Ian in a sense that institutions has a much higher entry bar from volume, from KYC, AML, operations, settlement aspects, fund admin, reporting, risk management, and most recently, you have seen also more traditional companies coming into the space, corporate treasurers more specifically, and those people are looking for not just what do I need to buy Bitcoin, what do I do with that Bitcoin? How do I custody this Bitcoin safely? How can I generate yield on that? How can I reduce the volatile aspect of the asset class, yet get exposure to it? How can I get a non-native crypto aspect to the asset class, like the NDFs and alike? So we see more bridging now between the traditional space and the crypto, I call it savvy or crypto native aspects, and you will see a lot more development on the, derivatives, financial products that is going to help us not just attract those traditional companies to the space, but also help them achieve their investment strategy, which is the critical point here. And we can get maybe, if we have time later, into the liquidity, credit aspects, and all the other issues that large institutions like that care about.
Before we jump into custody, which is obviously near and dear
just
to
a comment on that.
Please.
So if you're a blue whale, you're an institution, you're like a blue whale, right? You have your own feeding grounds. If you're a retail guy and you're a killer whale, right, like a smaller whale, you got to buy your stuff somewhere else. I'll give you an example. GBTC right now, it's a grayscale product. You can buy Bitcoin at 10 to 15% discount. Same Bitcoin, 10 to 15%. It's trading at a discount, right? So you're buying it on Coinbase, you're paying full price. You're buying it on Grayscale, you're getting a discount. So at Celsius, we're managing about 20 billion in assets, and we see where the coins are coming from. And I can tell you, the smart killer whales are hopping around. They're always buying where it makes the most sense. They don't constantly feed in the same grounds. So
that's a good point. I think before we jump into custody, which is near and dear to my heart as Prime Trust, I think you mentioned corporations putting Bitcoin on their balance sheet, which is interesting. Alex, you guys just announced 107,000 Bitcoin in kind of customer assets on the platform, which is a fantastic milestone. Congratulations. If you are one of these corporations and you're looking at putting on your balance sheet, kind of how do you get stakeholder alignment, right? If you're kind of the guy that's championing this, how do you convince the board? How do you convince the CFO? How do you convince these other people who might see Bitcoin as too risky, too volatile to actually adopt it? Do you have any thoughts?
Sure. So Michael Saylor, who I think is speaking tomorrow, is the extreme example of somebody who basically controls the board, and it can go and they basically say to the company, we're taking all of our money, we're putting it all on red, and that's how we're doing it, right? Most companies, most boards, you'll have really, if you're the treasurer, if you're the CFO, you're going to have a really hard time convincing them that it's a safe bet, it's the right thing to do. And you have to start that very slowly, right? You have to maybe start with stable coins, earn yield on stable coins, right? Like at Celsius, you can earn 8.8% on your dollars, and it's backed by a trust company, like a New York trust company like Paxos or Circle or other companies. So I don't think you start with Bitcoin. I think you start with other digital assets. And when your board is comfortable with that, you migrate to Bitcoin and get people more vested in generating some upside, not just generating yield.
What do you guys think for individuals who are a little bit of a different market than the institutions? For the individual whales, you mentioned get your Bitcoin somewhere else. For the two of you, you guys obviously also do high net worth individual business. What do you guys have any tips, advice, tricks for everybody in the audience who's interested in getting in.
Yeah.
Go ahead. No, I brought my my prop here. So if you don't know what to do, here it is. HODL. That's all you need to know. If you don't know what HODL stands for, we have a booth out there. We'll explain it to you.
The best. Mr. Novogratz this morning made the interesting point that we may have a bit of a headwind here as the Fed tucks tail on inflation rising. Look, I was a macro PM for 15 years. It's clearly going to send some jitters through the market. Things will move. But the Fed will also provide a tailwind. As the Fed steps into the breach, as the ECB steps in, as the Bank of Canada steps in, as 2 years from now we have official sector involvement supporting either stablecoins or having their own digital, retail investors who have a certain political bent, in my experience, should not fear this. This is something that will bring in the stabilizing large official sector holdings, large corporate holdings, and will get us real product, real tokenized product that is not in competition with Bitcoin. The whole space will be able to rise together. As more institutions get involved, they will have increased confidence from a more stable regulatory and monetary regime in how it treats this. And all I would say is retail investors that sort of had a political bent in this should not run from this more official sector involvement. They should see it, they should welcome it, and they should view it as a bullish tailwind.
Right. Actually, I would like to also add, there is the central bank's argument, but there is also the traditional banks in the space. I think funding is one of the major issues now in the crypto space. How do you get access to cash to buy Bitcoin, or what do you do with the Bitcoin? How do you get leverage or exposure to get cash back? How much interest you pay? So funding is very critical. So at Genesis, we think bringing in more banks, traditional banks in the space, to the game and working with them to actually create more liquidity in the space and offer more products is going to be a critical step towards even maybe getting more adoption from the central banks and alike. And to be more specific about the institutional companies, most of those companies want to work with regulated institutions. And this is how you start the conversation when talking to the CFOs and the GCs. It's not just because regulation means it's great. It's also, it gives them affirmation about what the company is doing overall. What is your exposure? What is your business model? How do you manage risk, liquidity, credit? And this is the things when people want to put large amount of funds with you, they need to understand those well, and they need to understand how do you react in a volatile environment and how you keep their assets safe. And this is more like the traditional aspects. And the other element is the blockchain, and it's a new concept to a lot of those companies. So you need to educate them about what the asset class is, where do we store the assets, why they are safe. And I don't want to go into more like the instant settlement aspects, all of that, but a lot of getting like those large corporations comfortable investing in crypto, it requires a lot of investment from like prime brokers and regulated institutions for sure.
You were talking about some of the lending stuff, and I think you guys did what, 20 billion in originations in Q1?
Yes, our last quarter we have 20 billion of originations, and our lending book is last quarter was close to $12 billion.
That's fantastic. I think the next logical step, at least in my mind, if you start to hodl a lot of Bitcoin, is how do you earn yield on it, right? And thankfully, we have some people that are much smarter than I am about those things. So maybe I'll turn it over to Alex first, and then to you on, if you have a new whale that's coming to you and saying, look, I've taken this position, I've amassed this amount of Bitcoin, I'd like to earn some yield off of it, and somehow, kind of what mechanisms are available, what are some trade-offs, things like that.
Sure. So the traditional options are store it in cold storage, don't touch it, wait for it to go up, wait a few years and you'll do just fine, which is okay. I mean, there's nothing wrong with that. And some people use their own keys. Some people give it to custodians like Coinbase or somebody else. What Celsius introduced, we were the first ones to kind of offer this on a global scale, is the ability to earn yield by effectively lending your assets to people who are willing to pay interest for it. So in this case, as you mentioned, we paid over 3,000 Bitcoin in interest, in income, to our hodlers. And the people who pay that are institutions who do market making, exchanges who need liquidity, right? So these are very established guys with big balance sheets who just don't want to take directional risk on Bitcoin, right? So if I want to do market making because the price on Coinbase and Bitcoin and Binance is different, right? I have to buy on one exchange and sell on another exchange. But if I buy the Bitcoin and do that trade and Bitcoin drops, I lost 10, 15% on the Bitcoin. If I borrow it from Celsius or I borrow it from the community really, then Bitcoin drops, I just return the same Bitcoin and the community for a short period of time lost that value. But I as a trader didn't lose it. So that's why there's huge demand for borrow. And again, Celsius is one of the largest providers of all that liquidity, and we extract all that yield, pay 80% of it back to our depositors, our users, right? And that's really the innovation. Wall Street has been doing SEC lending, the equivalent to what we do, for 100 years. They've never paid. Any of you got a check from JP Morgan or State Street or Fidelity or Robinhood? Guess what they do with your stock? They lend it out and make money. So what Celsius has done is basically extracted 80% of that back to the community, right? 3,000 Bitcoin and running.
Your thoughts?
Any Celsians here? Anyone using us? Here we go. A few hands.
Yeah, I mean, at Genesis, we take very traditional approach into our lending book. Basically now, we believe we are the largest institutional lending book now in the market. And we started the desk really in 2018. It's more like a friends and family, and it grew a few $100 million in 2018, maybe close to $500-600 million the year after, but now it's at $12 billion. What we do, we are in a unique position because we have a large trading operations globally, spot market, derivatives, and when we look at the lending book, aside from the demand and supply aspects, we understand the funding market very well in the space. We know where the liquidity pools are. We have one of the largest, most diverse client base globally, and that allow us to actually, across people, lend, borrow, keep our balance sheet moving at all times. At the same time, we implement a lot more traditional measures around how we manage the book, how we keep liquidity, and again, having the spot operations, derivative operations, we can see a lot more information about the market and how we should position our lending book in a way that if volatility is high or the market selling off. So that gives us a lot of room to actually manage the book and pay the best interest yield possible to our institutional clients. But this is just the traditional space. We offer a lot more products actually. People want to come get leverage. For example, Bitcoin is our 50% of our lending book. Like origination was in Bitcoin last quarter. Bitcoin is like the gold of the collateral, like with cash. And many people come in and they say, I have 100 Bitcoin, I want 300 Bitcoin exposure, right? So we offer leverage products, but it comes with very also a strict risk program around margin calls and all of that. And I mean, knock, but we have been doing this for 3 years, which is like infinity in the crypto space. And we have been doing very, very well.
I'll just chime in. We have a unique, across our family of companies, we have a unique traditional business and we have a unique crypto business. And I'd say the borrowing and lending aspect goes both ways. This is a $1.5 trillion, $2 trillion space right now that's largely unbanked by the fiat money center community. For our traditional asset managers and hedge funds, there's a clear opportunity that they're taking advantage of to provide dollars into this system, achieve very attractive fiat yields for providing 50% LTV type loans to this space. In this way, a space that is undercapitalized from a fiat perspective, because there are physical assets. If you're a miner, you need to buy machines, and the list goes on. There's tax efficiency, et cetera, et cetera. We're seeing a real transition right now through borrowing and lending for traditional asset managers and hedge funds to get their feet wet in the space. And as they do that, as they get wallets, as they figure out custody, as they figure out these pieces, their gateway, if you will, is in being the traditional lenders they know how to be in traditional fiat. And so I think the borrowing and lending works both ways, and it's really going to cross over the classic world of Wall Street and this new crypto native world. And we're seeing that borrowing and lending really span both sides of the wall.
I think this is going to be a bit of a loaded question, but obviously self-sovereignty is a really core tenet of the Bitcoin community. If you're a whale out there and you're looking and you're trying to decide, am I just going to hodl, am I going to keep my keys and do things like that, or should I be earning yield on these assets? I would imagine, especially for institutional buyers, that's probably a fairly hotly debated topic in the boardroom, right? What would you guys say, again, maybe starting with Alex and working our way down, what would you guys say would be the top criteria for making that decision? What are the most important points to consider that would tip the scales one way or another?
Yeah, so look, crypto started with not your keys, not your coins. And I think we kind of exhausted the people that are good at managing their own keys, right? We have like 3 or 4 million coins that have not been touched for several years. So obviously, even the pros don't know how to manage keys well. So you want to bring the next billion people into crypto to hold Bitcoin, they're not going to be able to manage their keys, right? So you want your coins, you want your bags to be worth more. You got to make it really simple for those people who don't know a private key from a public key, right, to come in and benefit. And one of the benefits is yield, right? Because the banks, the central banks don't offer yield anymore, and here you can earn 6% on your Bitcoin. It's a no-brainer for most people. So offering, like what Celsius does best, is offering that bridge, right? The ability to interact with a wallet exactly the same way like you interact with your Twitter account or Facebook account. You forgot your password, you can reset it. You know, somebody else keeps it safe for you. And by the way, while you're sitting and waiting, it earns yield as well. So corporations, to your point, corporations see it exactly the same way. Because corporations have, okay, can I entrust one of my employees, only one, to have a key? What happens if they run away? What happens if they leave the company and so on? So there's all these issues that have to do with custody that are solved by having a platform like Celsius. So we have thousands of corporate accounts, and I can tell you that a lot of the treasurers and the CFOs who deal with buying and managing this stuff look at it, okay, who is my custodian? How do I do multi-sig, meaning I need 3 signatures, for example, to withdraw a deposit, and all these things matter, and that's how we grow the community. We grow the community, the price of Bitcoin is going up.
Ian, I'm going to modify the question a tiny bit for you because I love your traditional background. If you have someone that's new to the crypto space and getting into it, how do you explain this concept to them?
Right. This is the key operational pinch point for hedge funds that we're talking about, is how to custody. We can introduce them to folks like yourself. You know, the expectation is that the Bonings of the world get into this in a robust way. But there's got to be a very good custody solution. I don't think you're going to see multi-billion-dollar hedge funds and asset managers cold store keys in the desk drawer, you know, of their COO or their head of operations. I just don't think anybody wants to bear the liability for that. I don't think that's going to make anybody's LPs comfortable. I think we need some industry standards. We need some industry best practices. We need some idea on a regulatory piece for some degree of indemnification on the risk associated with that. And so whilst public blockchain is the better form of money, whilst it is the future of finance, there needs to be some area here for these fiduciaries to get some protection operationally and otherwise in how to be able to hodl, hold, trade, store, custody. We're going to have to solve that piece in a very serious way to get the next 100 million wallets and the next million very high-grade institutional wallets in the game.
I think I'm going to give you the last word as we're running out of time here a little bit. How do we get to that next step in your eyes that Ian was just talking about, having to get to that next step for these institutions to come in?
Well, in the interim, we are working to be single point of access for prime brokerage for our clients. So basically, our clients come different flavors. The long-term investors who just want to hold their Bitcoin, we build our cold storage solution where people can park their assets there for life with the right controls. But for people who are deploying assets and they need intraday liquidity, all of that, we facilitate this. At the same time, we assure them through our regulated entities, through our credit buffers, all of that, that we are able to service them on day-to-day and settle properly. So again, you get different flavors of all those people, but at the end of the day, you need to be able to explain the technology, offer the solutions, and offer the right products, which is around lending and derivatives and alike, where people want to come to you to do everything at once and for good. What's happening now is the market a bit fragmented. A few companies are known to be the best at certain things. And we are not like the traditional prime brokerage where people connected and you can settle easily all of that. But I think regulation will help tremendously the space. I agree with Ian. And I think it's going to help all of us open up the door for people to even face multiple prime brokerage. We don't want to repeat the story of the crisis where people were facing one brokerage, everything was gone. All even large institutions now work with different prime brokers to diversify, and we need to get there.
Gentlemen, thank you for sharing your expertise with everybody out there. For everybody out there, all these fine gentlemen and Prime Trust and Bank all have booths outside in the exhibition hall. If you have more questions or want to follow up on any of the topics, I'm sure they'll be more than happy to talk to you over at the booths or people from their teams will. No, thanks, guys.
Thank you very much.
Here we are, last panel before lunch. Appreciate you guys sticking with us. If you've been at every session today, give yourself a round of applause. You've earned it. And we've got Really a talk on a great subject, how to value Bitcoin. One of the things that still keeps me fascinated about Bitcoin. How do you value this technology that has not existed before, that there is no corollary? Here to talk about it is Brian Estes, CEO and CIO of Off the Chain Capital, the best performing Bitcoin hedge funds of the last 4 years. He's going to give you a great talk about how to value Bitcoin and answer this question for you all. Welcome to Brian to the stage.
Hello, everybody. So I'm here to show you how to value Bitcoin. It's the biggest question out there, right? So every day I see people making the same mistake I made 30 years ago. They don't know the difference between price and value. This is me 30 years ago, a newly minted stockbroker with a company called A.G. Edwards. I was 22 years old at the time, and I didn't know how to value stocks back then. When I look at this picture, I see the fire in my eyes, but to tell you the truth, I had no idea what I was doing. So what I did was I sought out one of the most experienced brokers in our office. Leo Samet was 80 years old. He was born in 1911, and when I started A.G. Edwards in 1991, like I said, he was 80 years old. I went into his office and asked him, Leo, you've been with A.G. Edwards for 50 years. I'm sure you could help a new broker out by giving me some advice on how to be successful in this industry. We locked eyes for about 5 seconds, which seemed like about 5 minutes to me. And I knew exactly what he was doing. He was sizing me up. He goes, he was thinking to himself, does this kid deserve to know the secret of success with investing? And after about 5 seconds, he looked down at his desk, he reached over, slid a piece of paper over to me, and he said, put all your clients in this, and you'll be just fine. What he did was he slid me a research report on a company called Berkshire Hathaway. All I could see was the price. I could see $8,300 for the price of Berkshire Hathaway. I didn't know how to value a company. All I could see was the price. And I looked at him and I was like, Leo, this is $8,000 a share. My clients aren't going to buy an $8,000 stock. Why don't you show me something like at $1 or at $10? And the mistake I was making is I was looking at the price and I didn't understand the value. I didn't understand the value of Warren Buffett's expertise in investment management. I didn't understand the value of the cash flow that was being generated by the company. I didn't understand the value of predicting interest rates were going to drop from 10% on the US Treasury, 10-year Treasury, down to 1%. And so all I was looking at the price. And because I didn't know the difference between price and value, I missed it. Berkshire Hathaway over the last 30 years went from $8,300 a share up to over $400,000. It's about a 5,000% increase. And like I said, the mistake I made is I didn't know the difference between price and value. So when I learned about Bitcoin back in 2014, I thought it was a total scam. I come from traditional finance. I saw this internet funny money that people said were being used for nefarious activities. But I understood that we were going to use open source blockchain protocols to rebuild our entire financial system. So I invested in Bitcoin. I didn't know how to value it back then. It took me 2 years to figure out how to value Bitcoin. So now what I'm going to show you is how to value Bitcoin so you don't make the same mistake I made 30 years ago. Because we know how to value Bitcoin at Off the Chain Capital, this has enabled us to be the #1 performing blockchain fund over the past 2 years since we reopened the fund, and over the past 4 years since we started the fund. Okay, so before I get into our models, I need to give a disclaimer. So Off the Chain Capital is an SEC registered investment advisor. Because of that, what I'm going to show you are considered forward-looking statements. And so these aren't price guarantees of Bitcoin, and by no means does this constitute financial advice. Okay? So just to get that clear. Okay, so the first model that we use is based on S-curve analysis. So when I was studying at Cambridge University back in 1988, I learned about S-curves. And basically what S-curve analysis does, it predicts the adoption path of a new technology. Bitcoin started in 2009. By 2019, 10% of US households owned Bitcoin. Last year, Brian Brooks, the comptroller of the US currency, was being interviewed on CNN, and he said during that interview that 15% of US households owned cryptocurrency last year. There was a study issued out a couple months ago that surveyed 30,000 residents of the United States, and in that study, it showed that 25% of US households own cryptocurrency today. Okay? We're on this path to mass adoption of Bitcoin. Okay? By 2029, it's projected that 90% of US households will own Bitcoin. So the basic theory behind this analysis is that when only 25% of households own Bitcoin, it's undervalued. When 90% of households own Bitcoin in 2029, it'd be fairly valued. So Bitcoin is undervalued today. Another model that we use, I call it the trend is your friend, but basically all we do is we take the historical price of Bitcoin, we plot it out on a logarithmic scale, we run a linear regression line through the center of that. This model is 90% correlated to the historical price of Bitcoin. What this model shows today is Bitcoin slightly undervalued today. But what it projects, though, is that in about 10 years, Bitcoin's going to be worth somewhere between $10 million of Bitcoin and $100 million of Bitcoin. Okay, so you could laugh now, $100 million of Bitcoin. So, like I said, this model is 90% correlated to the historical price of Bitcoin. Another model that we use, it's based off Metcalfe's law. So Tom Lee at Fundstrat came up with this model a few years ago. And basically, we take a derivative off it. What we do is we square the number of users, which is how you value a network, and then we multiply the number of transactions and the volume of transactions going through that network. And we get a formula, or we get a model for that. Between 2014 and 2017, this model was 94% correlated to the price of Bitcoin. What happened in December of 2017 was that the price of Bitcoin and the model started to diverge. And the reason it started to diverge was that the CME started to allow people to short Bitcoin. People were betting against it. And then you had a lot of excess negative government branding around Bitcoin, calling it nefarious and criminal to use it. You had excess US regulations. And most recently, we've seen the model diverge because of all this ESG controversy, which in my opinion is completely fake news. Another model that we use, it's based off Plan B's model. So if you Google Plan B or Google 100 trillion USD, you'll find his research on his model. This model is 95% correlated to the price of Bitcoin. And what this model projects is that Bitcoin will be worth $100,000 at the end of this year, $1 million at the end of 2025, and $10 million at the end of 2029. And then we get to my most favorite model. So this is the stock to flow model, but we take dollars out of the equation and we insert gold as the monetary layer or monetary unit for this model. So when we first started looking at this model, it took 4 ounces of gold to buy Bitcoin a couple years ago. Today it takes 28 ounces of gold to buy 1 Bitcoin. This model is projecting at the end of this year it's going to take 100 ounces of gold to buy 1 Bitcoin. At the end of 2025 it's going to take 1,000 ounces of gold to buy 1 Bitcoin. And at the end of 2029 it's going to take 10,000 ounces of gold to buy 1 Bitcoin. So 10,000 ounces of gold today is worth $18 million. This model is 99% correlated to the price of Bitcoin. You can't get more accurate than that. This is the model that we rely most on, is the stock to flow model based on gold. So just to circle back to the lessons I learned 30 years ago, I see people making the mistake with Bitcoin today that I made 30 years ago. They don't know the difference between price and value. When I see people buying Dogecoin, I ask them, why are you buying Dogecoin? Well, because it's 34 cents. I can't afford Bitcoin at $38,000. That's the mistake I made 30 years ago, right? So why are you buying Bitcoin Cash at $600? Because I can't afford Bitcoin at $38,000. That's completely the wrong way of thinking about it. We own Bitcoin because it's the most valuable asset on Earth today. So after Ethereum converts over from proof of stake, or from proof of work over to proof of stake, Bitcoin will constitute 88% of the proof of work protocols. Doge, Litecoin, Bitcoin Cash, Monero, Zcash, they'll constitute the other 12%. So the world has decided already that Bitcoin is the winner. So just to close, I see Bitcoin as being the most valuable asset on Earth today. No matter how high the price goes on Bitcoin, there's only a finite number. There's only 21 million Bitcoin that could ever be created. And because there's that finite number, the price will continue to go up, and it will become the monetary layer of the world. Bitcoin has the ability to set us free from fiat currency because we're now able to control the value that we create, and we're able to hold our own money. I'd like you to watch this 60-second video before I wrap things up.
I am William Wallace, and I see a whole army of my countrymen here in defiance of tyranny. You've come to fight as three men. And three men you are. What will you do without freedom? Will you fight? Against that? No! We will run! And we will live. Alright? Fight and you may die. Run and you'll live. At least a while. And dying in your beds many years from now, would you be willing to trade all the days from this day to that for one chance, just one chance, to come back here and tell our enemies that they may take our lives, but they'll never take our freedom?
Like William Wallace, I see a whole army of revolutionaries in front of me. We are paving the way to financial freedom. You don't have to die for freedom, though. You simply have to take 2 steps. Step number 1 is buy Bitcoin. Step number 2 is never fucking sell it.
All right, what a great ending to our morning sessions. The organizers here at Bitcoin 2021 would like me to let you know that lunch is served. Pitch day starts at 1:45 p.m. That's going to be in Bordeaux, the building that looks like a giant octopus. So if you want to go see some great Bitcoin startups, some great Bitcoin companies, pitch day over in the giant octopus. That's the deep dive. Investors and VCs are welcome, and we're going to resume back here at 2 p.m. Thanks, everyone.
Hey, everybody. How's it going, Miami? Bitcoin Miami. My name's Bruce Fenton. I'll be MC for the rest of the day. Grab your seats. We've got a great panel coming up to start it off. The topic is Bitcoin. Anybody want to hear about Bitcoin? Bitcoin, options, and derivatives. Rich Rosenblum is running a little bit late. He has notified us that he is stuck in traffic. But I'll introduce the rest of the panel, and then Rich is going to join us after we start. Shilang Tang, CIO of Ledger Prime. That's the kind of welcome I like. Come on out.
Oh.
There you go. And then Gomes, CEO of Paradigm. And this panel is going to be moderated by Tyler Evans, who is co-founder of BTC Inc. and managing partner of UTXO. Let's give him a hand.
Thanks, Brady. All right, hello, everyone. I hope we're not going to put you all to sleep after that lunch that was just served. But we're here today to talk about Bitcoin and options and derivatives, and we've got some of the best people in the world to do that. So I'll let these guys kind of introduce themselves a little bit more, talk a little bit about their company and how they interact with the options market to set the stage here.
You want me to go?
You want to start off, Anand?
Sure. Well, thank you, guys. Nice to be here. My name is Anand Gomes. I'm the co-founder CEO of Paradigm. Paradigm is an electronic institutional liquidity network, and our focus is options. So what we do is we provide on-demand access or platform so institutions can get on-demand access to liquidity. And I happen to be working with both of these gentlemen here, so super happy to be here today.
My name is Shilang Tang. Spent most of my career in derivatives trading. Launched Ledger Prime in 2017. We're basically a multi-strat quant fund focused exclusively on digital assets. We specialize in derivatives, so futures, perps, options, and obviously work a lot with Anand and Rich, who's not here. Excited for the space and continue to see how it'll innovate into the future.
And for ourselves, with our fund, UTXO Management, we do trade in some of these markets. We trade on Paradigm. We trade with Ledger Prime. So we're not in it as deep as these guys are, but have seen some of the opportunity and also some of the pitfalls that come with the derivatives market. So I guess to kick off this conversation, let's just kind of lay the groundwork a little bit. Maybe, Shilang, do you want to just kind of give an overview of the different derivatives that exist for Bitcoin and talk a little bit about kind of how that market has evolved?
Yeah, the market right now is really kind of bifurcated in a way between, I would say, kind of U.S. onshore regulated and kind of the offshore differently regulated markets, right? So like the U.S. we have CME, LedgerX, backed. Offshore, we have a slew of exchanges, right? You have Deribit, Binance, FTX, and Huobi, and basically a ton of others. In the U.S., right, you generally have obviously aside from spot markets, you have the futures markets, LedgerX, CME backed. Those are pretty standard kind of contracts that exist in other asset classes as well. And then the offshore, you have these perpetual contracts, which are kind of like CFDs, but they're pretty unique to the crypto world, and they represent a huge amount of the existing volume, in crypto and specifically in Bitcoin derivatives, right? In the option space, you have on the offshore side, you have Deribit, you have Bit, pretty standard, cash settled. Bitcoin denominated, but they're not physically settled, right? In the U.S. side, LedgerX is physically settled, and then you have this whole world of OTC derivatives as well, right? Bitcoin, but also other tokens as well. That's generally how it's bifurcated.
And then also in DeFi now, the DeFi space is growing extremely fast, and all the innovations, they've basically taken what exists in the traditional world and also in the traditional crypto space, and then now move that to DeFi's. A lot of really cool, interesting things. The Ledger Prime plays in that world as well. But yeah, it's super exciting.
And maybe if we could just take a step back for the audience too, like what are these instruments generally? Like why should people care about them? How are they relevant to the conversation we're having today?
Yeah, I mean, it's all about like it's risk profile. I usually like to view these things, risk and investment profile, right? People, have a view and they have a tailored investment or risk view and they want exposure to that, right? And derivatives generally sort of allow you to tailor whatever view you have and gain exposure to that with using some combination of that. One of the things we specialize in on our platform is the ability to do that. You do multi-leg strategies, call spreads, put spreads, strangles, straddles, delta neutral strategies, things like that. And so yeah, I look at it from the perspective of, it's people generally have a view, and depending upon who you are, if you are money manager, OTC desk, hedge fund, etc. Like there's a sort of wide spread of market participants, and so it really comes back to like what is their mandate, what are they trying to do, and if they want a more tailored view, then you sort of go towards the derivatives markets.
And you touched on a few of them, hedge funds, OTC desks, but who are kind of the main players in these markets, or who can benefit from using access to these derivatives the most?
Yeah, I mean it's a wide spectrum of people. We see our platform is very institutional focused, so we have funds like yourself, market makers, OTC desks, lenders. Lenders is a huge part of derivatives trading generally and options trading specifically because they have, they're lending out, crypto or stablecoin in some way, and they have all this crypto sitting on their balance sheet, so they need to hedge that risk. So, generally they're long risk reversals, which means they need to protect the value of the collateral on their balance sheet, but they also do things such as structured products. So effectively, it's just selling vol in some way, but that's selling calls or things like that. So effectively, they are a huge. Welcome.
Welcome, Rich.
And lenders are a huge part of this space, and then there's a whole sort of ecosystem, and then what I like to call also is rolled up retail, right? So there's people that face retail companies and retail participants, and they offer some sort of derivative, but tied or wrapped in sort of an easy to use way. You're seeing a lot of this in Asia. And then those companies need to hedge that risk, and ultimately they come to the institutional market, which is sort of where we play.
Cool. Welcome, Rich. You want to give a quick introduction on yourself and GSR and kind of how you guys interact with the derivatives markets we're talking about today?
Sure, thank you. My name is Rich. Before GSR, I was at Goldman for a dozen years managing the oil derivatives business. Came into crypto 2013, and GSR is a global trader, investor, market maker. One of our main focuses is on options and derivatives. There's often optionality embedded in our contracts. They have an OTC business where we bridge options and derivatives in for bilateral contracts. And happy to be here today, despite being late.
Great. And I guess maybe next, if any of you guys could just kind of give an idea for our audience about the size of these markets, the maturity of them, how they've developed, what's out there today in terms of what you guys are seeing on the institutional side.
Yeah, I mean, so I can start. I mean, futures is a huge business, right? I mean, well, depending upon the price of Bitcoin, we've seen it trade anything between 250 to 600 billion a day in volume. I mean, it's a massive market, right? Options are not as anything close to being big. I think max, what I would say, 4 or 5 billion a day we've traded so far, and that has also been fairly a recent development, right? Up until even a year ago, options were not that big, but like I said, the institutions have been coming, and again, they want exposure to this new asset class, and they want a tailored view. And options obviously gives you a view slightly different than just being long spot. And so that's sort of being a big catalyst for why it's done so well.
Yeah, I mean, you look at any other asset class. If you think crypto is an asset class that's here to stay, every other asset class derivatives trade 30, 40, 50x the size of spot markets, right? And crypto really is no different. It's becoming that way, and options, is kind of the last frontier of derivatives, at least the vanilla derivatives. That's really going to explode, we feel, in the next 12 to 18 months.
Yeah, I'd echo similar to that. I think there's usually this sequencing where options and exotics markets come later. So I think you have spot, the rest of the ability to lend, then you have futures, and then come options. And I think that there's nothing about this market that it means that options are going to stay lighter than other derivatives or lighter than spot. I think it's more of just a timing element, and especially when having dealt with corporates for a living, corporates tend not to want to use instruments where they have a one-day expiry, whether it's a future or an option. So I think it's these custom products that are help bridge corporate interest into the space, and it takes a bit more dedicated expertise by companies like the three of ours to be able to build the products that allow larger corporates and sovereigns to come in and be actioning into the products.
Yeah, so you mentioned in typical markets you see maybe derivatives trade 30x spot. What does that look like for Bitcoin today? How does that compare relatively?
It's probably like 5 to 10x.
10 times? Yeah. Probably good rule of thumb, at least for now. But that's, again, it's changing quite rapidly.
And so that's part of why all you guys are so bullish on the continued expansion of the options and derivatives markets, right?
Yeah, yep, exactly.
And we haven't even touched on the more popular instruments that exist in traditional markets, like a VIX equivalent, or like the many structured products that exist in traditional assets that haven't really penetrated, crypto and Bitcoin yet, right? So once those start to come, that would even add more growth and
and that's all
liquidity.
on top of what already we just described. So I mean, there's a long way to go in this space, and companies like GSR do a really good job of figuring out what a company needs. If we started talking about, corporates have a risk management motivation to come into the derivatives markets, right? Investment houses have an investment mandate or view, and companies like GSR does an amazing job of trying to figure out, okay, what do you need, and how do we sort of come up with a derivative to sort of match what your needs are, and then we sort of deal with the complexity on the back end, right? And so yeah, it's like I said, lots of promise for sure.
Yeah, let's talk about that for a little bit. You mentioned some a volatility index, some structured products. Where do you guys see kind of the big holes left out there to fill, or what's the new exciting products that are going to be coming to market, or that you're seeing demand for some of your clients?
I think that what makes this space unique is that there's both a highly regulated side and then a more retail side. And even though there's been retail interest in spot and derivatives, I think in options we've yet to see a DeFi play in options. There's over a dozen groups that are working on it. I think in the same way we saw this huge surge in DEX volumes start about roughly a year ago, I think we're about a year behind in options. So in the next year, I think that's going to be one of the things to watch.
So I guess one of those million-dollar questions out there that I get a lot, that a lot of our readers at Bitcoin Magazine ask, talk a little bit about the interplay between spot and derivatives, and does the tail wag the dog, or vice versa?
I mean, you need a robust spot market first, and that's what they call a derivative, right? You need a robust spot market first to even introduce, derivatives, right? And then you start to talk about volatile products like a VIX product, but you need a robust derivatives market first before you can introduce those products. Yeah, I mean, I think ultimately it depends on the time frame, right? In my opinion, if we're talking about short-term intraday time frames, a lot of times it's, in my opinion at least, derivatives, futures, options are on expiration, hedging, that drives a lot of the short-term movement. But over the long term, right, you have Bitcoin, it's a hard asset, there's only a limited supply. And so if the demand is there from retail institutions to soak that supply up, there's only so much that derivatives can do, right? And so in the longer term, in my opinion, it's still about, the spot markets, the demand for the hard asset, but on a shorter time frame, intraday, derivatives often definitely drives a lot of the price action.
I mean, you also see this in the traditional markets where like options volumes have become so huge that like the delta and the gamma effects of dealer hedging, people track that now because options markets are some big number multiple of the spot market, and they all have to ultimately hedge using the underlying, and so the spot market now is like subject to the gyrations of these like huge these forces. So yeah, I mean, ultimately I think that if there's two markets that exist, in which are contingent on sort of each other, they're sort of it's inevitable that one will affect the other. I think the size has a lot to do with it. Like whichever market is like bigger, will tend to obviously have a more outsized impact on the other market. Just because if there is interplay, then obviously size is a multiplier by which that relationship is governed, right? And so yeah, I mean, I tend to share Shalang's view that derivatives definitely have a huge impact on the spot market, but then also from time to time you will see where like you'll see like a spot-led rally where institutions are coming in and sort of buying up Bitcoin, and you're seeing volumes on Coinbase sort of increase, and then the derivatives market sort of react, right? So I tend to think of it as like this dynamic relationship that is sort of changing constantly.
How about even with the events of the past couple weeks, the sell-off, the kind of leverage wipeout? How have the derivatives markets kind of adapted to the equilibrium point we're at right now?
I'd say, in general, during a maturation process, you'd think that more tools would make things more efficient and more transparent, but it always comes at some type of cost. I think even though the advent of derivatives has made it so that people could get the same outcome out, but have it cheaper, more efficiently, have it happen more quickly, I think that there's also added volatility in some cases. So I think that futures have allowed the ability to have retail other participants borrow internally from the marketplace, able to get long 4 trillion, even though there's only 2 trillion of cash contribution, because they're borrowing and having leverage within the space. And I think that in the way derivatives can make future risks become prompt, you can sort of see the future with how people are trying to bet today in a futures market in a way you can't with spot. But I think one of the weaknesses of that is that if the market is over-levered and oversaturated in a specific trade, like being long Bitcoin futures and options, you can have a bigger fall than you otherwise would have. So maybe we got to 60,000 quicker than we should have, but the downside from that is we fell right down to 30,000 quicker than we should have had.
Well, one of the other things that makes everything sort of worse in crypto is just cascading liquidations. Right. Like if the move, the nice things about the orderly the traditional market is like the concept of circuit breakers, right?
Sure.
Circuit breakers exist for orderly liquidations, right? So that and if you think about it, liquidations are account transfers. In crypto, because the market never sleeps and the exchanges need to get out of these positions, the sort of what the market has sort of come to is this idea of taking liquidated accounts and jamming them back into the order book. And that has the unfortunate effect of sort of accelerating the move in whichever direction the market is going up or down, and that sort of and then of course there's more people get liquidated at those lower levels, right? So it's a terrible sort of problem. Now it's a little bit of a shameless plug, but we're working actually on a solution where effectively we are working with exchanges to deal with liquidations away from the order book, right? So talked about market infrastructure evolution, like we think this is like one of the steps where effectively the exchanges, instead of taking that order and jamming it back into the order book, they can run it as a liquidation auction, like as an RFQ with a set of dedicated market makers, and then once the price is cleared, we then clear it back into the order book, right? And of course we think, obviously we're biased because we're building the solution, but
Bitcoin, which are two kind of aspects, the steepness of the contango curve that don't make a lot of sense to people looking at this with a traditional lens. Can you guys talk a little bit about kind of why that curve exists, why that funding rate exists, and what the opportunity is there?
Sure, I'll kick it off and say that if you look at mining as an industry, Bitcoin, crypto mining, it's a high return business. And so if this is a business that's returning, triple digits of return, they can comfortably borrow in the double digits.
That's quite different than traditional finance where rates or these risk-free ranks are in the near zero or negative, depending which country you look at. So I think that mining is one of the most basic ways to create a return, as well as DeFi, which is so far more Ethereum-based. It's another way to create a higher interest rate return. So I think the base level of interest rates in crypto is significantly higher